This cycle has been very much infrastructure CapEx driven.
I do think you favor tech here.
We're bullish on the S&P, but we're probably even more bullish on this rally broadening out.
The basic thrust of the market is to go higher.
Missing out on the upside is like participating in the downside.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, facing down higher prices, crude bouncing, following another round of strikes on Iran as Fed officials are bracing for a jump in the latest inflation data. Earnings from Costco to Best Buy offering a read on the U.S. consumer. That consumer is getting squeezed.
And we get those earnings later today. Best Buy before the bell, Costco after the bell. You know, there's been a dissonance because all of the negativity has come with data that has otherwise been really resilient. And the reason why we've seen inflation be sticky is because consumers have been able to absorb this. Are we starting to see fraying around the edges? And that is what I think will be interesting from Best Buy and Costco. Do they show what we're hearing from some other places? Top end of the consumer still spending, lower end of the consumer looking for bargains, pulling back.
Energy prices multi-year highs. Check out mortgage rates 6.5%. PCE expected to spike today, and the Fed stuck between a rock and a hard place.
Rock and a hard place. So is this administration. I was pretty shocked yesterday. The Treasury Secretary sitting down with the president at the cabinet meeting decided to use the T word when he talked about prices. Right now, he says it's transitory and things like gasoline will come down when this war ends. And right now, Jonathan, it looks like actually the ceasefire is barely holding on when it comes to the conflict.
Let's spend some time on that. Let's bring up the crude price. Brent, WTI, check it out. We're up this morning by not even 2%. And what we've seen overnight is the second round of strikes so far this week and zero progress towards making a deal. Yet this is the move on crude this morning. That's nothing. If you just looked at that, waking up today, you wouldn't have a clue what happened overnight.
Yeah, the fact that actually there were active strikes, that Iranian drones were shot down out of the sky. The way you could potentially read this, if you want to be really positive, is that the U.S. is essentially escorting ships or trying to keep ships flowing on the margins through the Strait of Hormuz that aren't necessarily Iranian. So at least something is getting through. It is leaky. On the flip side, the fact that there is kinetic warfare, but everyone's saying there's nothing to see here, gives you a sense of the cognitive dissonance.
But the red lines are being blurred. And what the United States is doing is they are responding to Iranian attacks. This is not necessarily deterrence. It is defense in that nature. And at some point, you have to basically ask the administration what would constitute, at this point then, an end to the ceasefire, because you're acting like this is pretty defensive in the Strait of Hormuz.
That's the energy story. 2 minutes into the show, let's bring up the tech trade. Salesforce versus a very, very different story coming from Snowflake. And the opening up of a discussion about winners and losers. Snowflake up today. Check it out, not a typo. Up by close to 40% in the pre-market. Salesforce down by close to 2%.
Yeah, so this goes to the forward look, right? And the idea that we're looking at Snowflake potentially partnering with Amazon.com for a pretty big deal using some of Intel's chips. This question around exactly how they're going to adjust and adapt to the AI era. Meanwhile, Salesforce actually disappointed, and it was a small disappointment on its earnings, but just a little bit of disappointment gives people a little bit of agita about the road ahead. They have to prove they have a very big moat around them that prevents themselves from getting disrupted out of business from people doing it themselves with all of their little programming bots, because essentially that is the fear.
Dan Ives, 6:30 Eastern Time, joining us on this program to break down the software trade. Coming up this hour, we'll also catch up with Bob Doll of Crossmark as equities pull back from record highs. General Karen Gibson of Academy as new strikes test the US-Iran ceasefire, and Kay Her of JP Morgan Asset Management as the Fed awaits a fresh read on inflation. We begin this hour with the US striking Iranian military targets for the second time in just 3 days. Bloomberg's Tyler Kendall joins us now from Washington for the latest. Good morning, Tyler.
Hey, John, good morning. Well, a U.S. official characterized this latest round of military strikes as being defensive in nature after Iran launched several drones at commercial ships in the Strait of Hormuz. It comes after just yesterday, President Trump maintained that no country will have formal control over the strait in any potential deal, as the waterway remains one of those top points of contention in the ongoing talks. The president also added that the U.S. would, quote, watch over ships that are transiting through, though declined to give specifics on how the U.S. is thinking about ensuring freedom of navigation. At this point, the White House says it's not satisfied yet with the progress in the ongoing Dialogue, though, has appeared to confirm that the U.S. is pursuing this phased approach where we would see the Strait of Hormuz prioritized to be reopened and only then formal conversations about potential curbs on Iran's nuclear program. But as we try to glean any details on what is in this potential memorandum of understanding, I asked President Trump yesterday during his cabinet meeting about whether or not the U.S. is considering easing sanctions as Iran pushes for financial relief as part of any deal. But he told me that's not happening anytime soon.
Is the U.S. considering easing sanctions on Iran to allow Iran to sell its crude to market?
No, we're not talking about any easing of sanctions or giving money. No sanctions, no money, no nothing. We have control of money that they claim is theirs. We'll keep control of that money.
John, I also asked President Trump whether or not he was expecting Congress to pass a federal gas tax holiday as the administration faces pressure when it comes to retail gasoline prices and we get closer to November and the midterm elections. He told me it's something that they might talk about, but ultimately he wants to give negotiations 1 to 2 more weeks, in his words, before he thinks about that.
Tyler Kendall with the latest down in Washington. Tyler, thank you. We'll catch up with you in the next hour. More to discuss down in Washington, D.C. It's a complex, multidimensional negotiation between 2, maybe 3, 4, 5 sides across the Middle East. Let's pick out 2 dimensions of that. Let's start with 1. Iran wants to control the Strait and the US wants free passage. 2. Iran wants to keep the uranium and the US wants it either destroyed or sent to the US. And I have seen little progress on either of those 2 major aspects of this very complex negotiation in the last few weeks.
That's the reason why when you hear this administration say it's 95% done, just these 2 major sticking points that were the ostensible reason for the war are still remain to be negotiating. From the market's point of view, though, I wonder whether that actually matters. Is it just the idea that there actually is some movement through the Strait of Hormuz, agnostic to exactly the method or the longevity of that? That's the sort of interesting aspect, maybe, of what we're seeing play into markets.
But that just got a whole lot harder as of last night because OFAC decided to sanction the Persian Gulf Strait Authority, basically the tolling booth the IRGC is using to collect these tolls. So if you're a trader that's been maybe trying to go through whatever bank this is in China or Hong Kong with this Bitcoin to get your vessel through for $2 million, Treasury is basically saying, we will find you, and now we're going to come after you.
Equities this morning not blinking. We're down just 0.15% on the S&P. Here's the view from Wall Street. Bob Dole of Crossmark Global Investments writing, investors are positioned for an imminent reopening of the Strait of Hormuz, which increases the short-term risk for asset markets. Bob joins us now for more. Bob at the studio. Good to see you, sir. Good morning.
Same here.
Is there a credible bear case for this stock market, and what is it?
Good news is good news, bad news is good news, no news is good news. What more do you need to know? Look, you know the story. It's all about earnings. Earnings expectations for this year are 15% higher than they were at the start of the year. That's not a 15% growth. That's 15 increased growth rate. And the market's only up 10. So PEs are down 5 since the first of the year. Hard to throw mud at that.
Some people throw mud at it by simply saying it can't last, that this is backward-looking, it's not forward-looking, and it hasn't fully adjusted to some of the pressures that we're seeing overseas and the supply constraints. What do you say to that?
I say back to earnings. If you're telling me earnings estimates are not going up any further, I fully agree with you. But as long as earnings are moving up at this pace and the Fed is not antagonistic to the stock market, stocks will move higher.
So why is there this incredible earnings boom if you're not seeing it in some of the consumer data? I mean, you're seeing resilience, but you aren't seeing this kind of boom condition. And you get a lot of commentary about people feeling pretty crappy.
Great question. I don't think first quarter earnings have answered that question very well. Top line growth's been just fine. It's margins that have exploded. And now, is that because companies haven't had a chance to say, my profits are up so much, where am I going to spend money to increase my business, and therefore it's all gone to the bottom line? I think there's some of that, but I'm with you. The consumer seems to be fraying, particularly at the low end.
Does it matter? Does it matter to the index? Certainly matters to a lot of people, but given the composition of the S&P 500, does it matter? And I know that's an uncomfortable question to really answer directly, but do you think it does?
Yeah, it's the right question. It matters less than it used to, can I say it that way, because of the percentage of the market that's related to the stuff outside the U.S. Technology, I mean, who cares what happens in the Strait of Hormuz to some degree, the technology sector might be saying.
It sounds so complacent, but then you see the capex intentions of these companies, and the numbers are astronomical. And they are driving GDP to a greater extent. We had a conversation just this week about whether the Federal Reserve can really slow this thing down. Apollo's Thorsten Slog saying the Fed is fighting FOMO. It's fighting more than that. It's fighting price-insensitive investment from some of the biggest, richest companies on the planet.
Yeah, essentially, is Amazon or Microsoft going to stop spending because the Fed raises rates by 50 basis points? The answer resoundingly is absolutely not. Key question, when does it actually matter to the physical world? Because this is a very physical process to build this stuff out. Suddenly that does enter into the inflation picture. That's why I said, this idea of, fantastic earnings momentum is maybe a fear of surging prices, because ultimately we end up in a place where the real pain comes from inflation.
We're raising a lot of money and pushing it through a supply-constrained economy that's gone through several supply shocks across goods, labour, and now energy. Is the end result just higher prices?
I think so, and that we're on to the real problem. It's inflation. I know it's not 6%, but it's not the Fed's 2%. It's 3.8 at the headline level last 12 months, 2.8 ex food and energy, rising. That's just not good news, and the stock market seems to look the other direction for now.
So the Strait of Hormuz does matter, though. It just matters to different people.
I think it does. My view is, and we could talk about everything we're hearing, I think it's going to be a two-part deal. The first will be, let's get the Strait open, and we'll make some concessions to make that happen, is my guess. And then we'll have a multi-month period on the uranium, and that's where I think it falls apart.
The issue is the concession the Iranians would be willing to take from the United States to open up the Strait of Hormuz is the United States red line. It's about enrichment of uranium. So it feels like they're talking past each other because the red lines are not moving.
Agreed, but I think that if they separate the two, there's a chance we get some solution around the Strait, punt on the uranium issue, deal with it later, and then it falls apart.
So what do you do? I mean, given the fact that ultimately you do see the potential for bad news, it has not paid to hedge against that. It has not paid to be skeptical. It has not paid to really know more information, it seems like. This idea of the less you know, the better off you are, which is something that Chris Verone was talking about. Do you go just into big tech and avoid bonds? Because ultimately inflation is a bigger concern.
First of all, context. I believe we're in a high-risk bull market. Bull market means you got to be invested because the path of least resistance is higher. Why? Earnings, earnings, earnings. and a Fed that is not antagonistic, at least yet. The high-risk part says, but if something goes wrong, the decline's not going to be 2.5%. It's going to be a lot worse than that. And that's what I'm watching every day, fully invested. Where are we invested? We're trying to go where, more reactionary than usual. That is to say, in this environment, letting some semiconductor stocks go, not the whole thing, just bits and pieces, and buy stuff that has okay fundamentals that's a whole lot cheaper. That's the trade I'm playing. Maybe 2 weeks from now, semis will have corrected. We'll be buying them back and selling the whatever we bought in the meantime.
Which is why they haven't corrected much, because everyone's just waiting to buy the same thing. Can I just ask you, what is an antagonistic Federal Reserve? A Fed that drops its easing bias? A Fed that talks about hiking 25 basis points? When does it become so-called antagonistic?
The fact that the market hasn't begun to think it's antagonistic blows my mind. It's because of earnings.
I'm shocked.
But you're absolutely right. This next meeting, they have to move to neutral, if not to a tightening bias. Maybe it's neutral bias, next meeting tightening bias, and then we'll have to see if they're going to raise rates. Market will not like that at all.
Bob, it's good to see you. It always is.
All the best.
Thanks for being here. Thank you, buddy. Bob Dole of Crossmark Global Investments. Futures this morning doing okay, down a few tenths of 1% on the S&P 500 this morning. With an update on stories worldwide with your Bloomberg Brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, good morning, John. For the second time this week, the U.S. carrying out airstrikes on Iranian military sites. Officials saying the attacks were defensive and intended to maintain the existing ceasefire. The attacks coming hours after the U.S. denied an Iranian report of a peace deal. Snowflake shares surging in the pre-market, the software maker giving a stronger than expected annual outlook, also signing a $6 billion multi-year agreement to use Amazon's cloud services and chips. American Airlines CEO Robert Isom says travel demand held up in the first quarter. Speaking with Lisa, Isom saying both business and leisure travel has improved despite global economic uncertainty.
Year-over-year revenue improved 10-11%, and we're forecasting revenue to improve 15%, year over year. In a year where price of fuel has spiked $4 or $5 billion, we're still projecting the same type of profitability that we had last year. That means good things.
Isom also saying American intends to grow its premium seating at twice the rate of its main cabins. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Great exchange yesterday. It's just amazing to see rock bottom, consumer confidence, and then hear the words tremendous demand come out of another airline.
The airline industry is a perfect example of a K-shaped economy because you have a very much tale of two consumers, and you're seeing one do very well, one not so much. And for a lot of the big players, it just doesn't matter.
Said it a few times. It's the Delta Airlines economy. Half the country is struggling and half the country thinks it's Group 1. And they're lining up for the lounge.
I think everyone thinks that they're Group 1. I think that everyone feels like they deserve it, which I understand.
You are Group 1, Bramo. Yeah. You're Group 1.
Definitely
You're
not.
Group 1.
Usually 4 or 5.
If there's more than 5 people in the line for something you're lining up for, if there's a line, none of you are Group 1. All right? Up next on the programme, diplomatic deadlock.
Iran is very much intent. They want very much to make a deal. So far, they haven't gotten there. We're not satisfied with it, but we will be. We will be either that or we'll have to just finish the job. They're negotiating on fumes.
Just for the record, I'm in the line. And I'm not Group 1. All right, just want to clarify that, okay? Just want to make sure that's clarified, okay? No.
You're not Group 1.
No. It's been very clear. You know, we sort of lost track on what exclusivity actually is.
You're pre-boarding. Like you understand.
Do you know what I mean?
Yeah, exactly.
You know, for the people going to the airport this morning, if there's a line for the lounge, there's nothing exclusive about it, right?
I won't wait on a line for a lounge. I refuse. I'd rather go get coffee or food somewhere else.
It's a group bonding experience. I love it.
I'm pleased I've cleared that up. Up next, we'll catch up with General Karen Gibson of Academy Securities, live from New York City this morning. Good morning. Tons of earnings today, stacked with retailers. Check it out. Dollar Tree a little bit later this morning, 6:30 Eastern Time. Costco, The Gap after the close. Best Buy in the next hour. Look out for all of that going into PCE data at 8:30 Eastern Time. The scores into it look like this. Equity futures on the S&P 500. Looking to squeeze out a loss of 0.2% on the S&P 500 after just about squeezing out a gain in yesterday's session. On the Nasdaq down by 0.4%. On the Russell, negative 0.2. Check out the bond market yields shaping up as follows going into the 8:30 inflation data. Just a little bit higher at the front end of the curve, up by 4.06%, and a new voice, Jefferson, and another one, Cook, out of the Federal Reserve, voicing their concerns about higher inflation.
Yeah, Lisa Cook actually coming out pretty aggressively and saying if you don't see any disinflation, she'd be inclined to hike rates. My question, listening to all the Fed speak, where exactly are the people who want to maintain an easing bias? Other than...
Who are they?
I mean, who are they? Please stand up. I mean, ultimately, we saw Governor Myron be the one stalwart voice. He's off. He's not at the Fed anymore.
It's true.
Who is that person?
I think Chairman Powell should do an interview. Now Governor Powell.
Yeah, I agree.
Who weren't they?
I mean, who actually
wanted it that?
And if they didn't want that, why didn't they remove it?
There's a sense that some people believe this anyway. There's a sense that they wanted to maintain the easing bias for the incoming Fed chair, so he had the decision to make, and that it wasn't down to Chairman Powell. Maybe that was the agreement, because to your point, it's very difficult to find a Fed official right now who actually wanted to keep it.
So to me then, how does it serve as forward guidance? If it is ultimately a way of signaling to one another, you know, what about the rest of us who are in Group 7?
I'm with you, or Group 8 or 9. Or no group at all. You know, that exists too. Everybody else?
Ryanair.
Yeah, been there. No seat assignment.
Yeah, exactly.
Yeah.
The roof.
That was sport.
Yeah.
Brent crude this morning up by 1.7%. WTI up by 1.65. Under Savannah's this morning, a diplomatic deadlock.
The strait's going to be open to everybody. We'll watch over it, but nobody's going to control it. That's part of the negotiation that we have. Iran is very much intent. They want very much to make a deal. So far, they haven't gotten there. We're not satisfied with it, but we will be. We will be either that or we'll have to just finish the job. They're negotiating on fumes.
So here's the latest this morning. The US and Iran exchanging fresh strikes, with the White House saying little progress has been made towards a deal. General Karen Gibson of Academy Securities writing, I suspect and hope negotiations may be more advanced than either side is letting on, at least publicly, despite the rhetoric. And in many ways, the action too. General Gibson joins us now for more. General, welcome to the programme. Where do you suspect we have made some progress?
Well, I think that if we had a complete lack of progress, we would be seeing more aggressive actions on the part of the United States, whether that was additional significant sanctions or strikes beyond the ones we've been doing. You know, I maintain that the ceasefire, while fragile, is still holding despite the strikes that we've had over the last 3 days. What characterizes these strikes is that they are very narrowly specific to aggressive actions that Iran was alleged to be making in and around the Strait of Hormuz, Bandar Abbas, whether that was vessels laying mines that would potentially constrain navigation and traffic, or one-way drones. And it's important to remember that even under a ceasefire, you do not lose the inherent right of self-defense. So if we were not making progress in negotiations, we might see broader strikes further somewhere else in Iran that more clearly violated the ceasefire. But I think these are very defense-related, self-defense-related, and within the bounds of the ceasefire.
If these are defense-related, then is the United States doing anything in terms of deterrence when it comes to Iran?
Well, I think our presence acts as a deterrent as well. I mean, the fact that if Iran were to, out of the blue strike some kind of Gulf infrastructure or civilian targets or something else that was in the broader Gulf region against one of our partners, I think it would be, certainly I would expect the United States to take some broad action, probably additional punishing airstrikes. And Iran knows that we can do that and that we're prepared to do that, won't hesitate to do that. And that in itself is a form of deterrence.
Given these recent clashes, do you understand where the red lines are in terms of kinetic warfare between Iran and the United States?
Yeah. So again, you never give up the right of self-defense, even under a ceasefire. And so if these were activities that were identified that looked as though they would threaten navigation or directly threaten our naval assets and air assets that are there right off the Strait of Hormuz, that's permitted. I think that's an important distinction. And even Iran's counterstrike, in which they launched assets towards Kuwait, they claim to have shot down one of our predators. I don't believe it. It's always kind of a given that they're going to exaggerate for their own domestic audiences. Those are, I think, probably within the bounds of the ceasefire. I'd make two more points there. One, if we were striking dual-use military civil infrastructure elsewhere in Iran that wasn't directly related to the navigation in the Straits, that's probably not within the bounds of the ceasefire. Again, back to if Iran were to strike, say, Fujairah again in the Emirates, their port outside the Strait of Hormuz, that would probably not be within the bounds of the ceasefire. But the last point I'd make is that a ceasefire is not a real physical thing. It's a construct that's developed between the two negotiating sides by policymakers or leaders. And it's really up to them to decide that a ceasefire is no longer holding, whether it's because of a single shot across the bow or something far more extensive.
General, you said something there that I thought was really important, that Iran obviously exaggerates for its audience. The U.S. also tried to jawbone markets, and this is one reason why markets have tuned out. Who are the respective parties trying to speak to, and how is that muddying the message?
That's a terrific point. I think, both sides, in probably any conflict, I think the leaders are speaking, particularly in Iran, to their own domestic audience. They need to appear strong. They need to make the United States look weak. They want to make it look as though we are the ones that are about to give and concede something. That strategic narrative is actually also an area where we're competing. They are speaking directly to their domestic audience. Our president is speaking to our domestic audience, but there are also broader market audiences that both are speaking to. And I think we have to be really careful about taking literally everything that's said by a spokesperson from either government. There's often truth within it, but then there will be other things that are said that are hyperbolic or, again, intended to calm or influence markets, to shape public opinion, and to influence the other side.
We've been wrestling with that for months. General, appreciate it. General Karen Gibson there of Academy Securities. That was the question. We know what the audiences are. What do you trust? And that's the problem.
Yeah, in this swirl of disinformation, a lot of people have tuned out. And that's the reason why the moves are getting smaller and smaller as people say, earnings, 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 which is what essentially we heard from Bob Dahl earlier
Stocks
this morning.
down a few tenths of 1% on the S&P 500. Fresh strikes overnight. Check out crude. Brent and WTI were up this morning by close to 2%, not even a little bit earlier this morning.
I understand the market's focused on earnings, but when you're trying to understand what the teams are negotiating, it's why I look at what is happening. And we continuously see, I know that no one wants to say it's a break in a ceasefire, we continue to see clashes, and at some point the red lines just evaporate.
Twice in 3 days, we've seen that. Up next on the programme, we'll catch up with this guy, Dan Ives of Wedbush, on the winners and losers emerging in the software space. Coming up a little bit later this morning, check out this interview, 60 minutes away, catching up with the BNY CEO, Robin Vince. Looking forward to this. Need to talk about the Trump accounts and the fact the stock hit a record high earlier on this week. Robin, about 60 minutes away. Equity futures on the S&P 500 this morning look like this. Equity futures pulling back by just 0.2%. On the Nasdaq down by 0.4%. In the bond market, 2s, 10s, 30s shaping up as follows. 2s up by 2 basis points this morning, 4.06%. PCE 2 hours away. And this is the problem right here. Energy prices spiking higher this year is producing higher inflation and pushing the Fed into a corner. A Fed that is sounding more and more hawkish by the day.
The data points today are going to be really important for this. On one hand, you have oil prices a bit higher, and you have core PCE, and then you have earnings. And the idea of Costco and Best Buy, and if they come out robust, the way that we've seen some earnings come through, well, then it can be stickier because people are saying, oof, I don't like that, but I am still buying. And that is sort of the conundrum for the Federal Reserve that they don't want to have to see, but it seems like they're trying to wrap their heads around.
Such an awkward, crazy dynamic right now to see consumer confidence at record lows. Coming from you, Mitch. Whether you believe that, okay, but still, record lows and a stock market, record highs.
It has to do with inflation. The idea that people hate inflation. People feel like it is a tax on their paychecks. They see inflation prices going up more than they see their paychecks going up. That is just psychology and how it always has translated. So right now, people see that we are in a higher inflation moment. At the same time, that is very good for stocks as long as it's not run away, because ultimately they can charge more. And guess what? Their margins are growing, so they're probably charging a little bit extra. You put these things together, you get a surging stock market, you get confidence falling off a cliff, and you've got very confused Fed officials.
Well, you have the Conference Board as well not coming in too well when it comes to how consumers are feeling, plus University of Michigan, plus the polling. To Lisa's point, everyone hates inflation. Why I was struck by the Treasury Secretary decided yesterday to say that it's going to be transitory. This administration really does need to hope it's going to be transitory before the midterm elections. At the same time, what do we hear from everyone? The consumer still is resilient. They're complaining, but at the moment, they're still spending.
Still spending at the headline level, and that's driving this stock market too. Earnings, earnings, earnings. How many times have we been told that in this equity market? Your stock market just off record highs this morning. 3 hours away from the opening bell. Let's get you some single names to morning movers. Yahara has more. Hey, Yahara.
Hi, John. I did not expect Snowflake to be the star of earnings yesterday, but here we are. The stock is soaring nearly 40% in the pre-market after it raised its full-year outlook and said it signed a massive $6 billion deal with Amazon Web Services. But as you can see, this marks a clear sign of relief for investors who have grown increasingly worried about AI disrupting the software industry, but Snowflake is signaling the opposite here with usage for its new AI coding tool doubling from the prior quarter. Turning to Dell shares, they are also rising in the pre-market, up 4% after landing a nearly $10 billion Pentagon contract to help streamline Microsoft software across the U.S. military. But the timing here is notable because this name reports after the bell today, and AI server demand will be closely watched. Analysts expect sales in that category surge more than 600% in the fiscal first quarter, and they expect that will drive a revenue beat. And we end on Marvell. Those shares are falling nearly 3% in the pre-market, even after the chip maker posted a beat and a raise on what they're calling exceptional AI demand. But with Marvell shares up some 130% year to date, this may have just been a story of high expectations. John?
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, the US and Iran exchanging fresh strikes near the Strait of Hormuz. US forces shooting down 4 Iranian drones bound for a commercial ship. A US official saying the ceasefire remains intact. Elsewhere, Wall Street's biggest banks are calling for another banner quarter for their trading desks. Bank of America CEO Brian Moynihan and the JP Morgan boss Jamie Dimon both expecting double-digit revenue growth after posting record hauls in the first quarter. And finally, Salesforce and Snowflake reporting earnings in a key read on the software sector. Snowflake shares skyrocketing after the earnings topped analyst estimates, and it signed a $6 billion cloud deal with Amazon. Salesforce edging lower after its outlook fell short. It's the winners and losers in the software space.
Just in one chart, there you go. This explains the software story of 2026. The reason why you're not seeing Salesforce CRM down more is because it's already down some 30% so far in the past number of months. So we're already seeing some pretty big declines. Prove it. Show me the money. Show me your path ahead in an era of AI. That has been the story. It's not just the miss for Salesforce and revenues for the second quarter. It's also not showing a path forward that is credible enough to people. They did show that their agent force is really gaining a lot of steam. They did show promise there, but it's not enough to convince people that they've got the moat around them that Snowflake seems to be developing with their partnership with Amazon.com.
This is the moment to provide some hot guidance. That's the problem. And if you're in the software space, you need to keep providing it quarter on quarter on quarter on quarter to disprove the thesis out there at the moment, and providing a lukewarm, kind of cold forecast, not going to get it done.
And actually not breaking out some of the data in the same kind of granular way that you have in the past, which also was something that came out of Salesforce, also giving people a little bit of skepticism about exactly how to move forward. It hasn't been an easy time for Mark Benioff. He's been really struggling to try to prove the story of why software will still hold the same kind of high margin revenues that it has in the past in an era of commoditized bots.
Dan Ives of Wedbush maintaining his 325 price target on Salesforce and raising his year-end forecast for Snowflake to 280, writing there is growing speculation that enterprise software budgets have started to shift towards AI initiatives, cannibalizing software spend. But these results represent an important gut punch to the AI ghost trade. Dan joins us now for more. Dan, good morning. Good to see you.
Great to be here.
What is separating the winners and the losers right now in this space?
Look, I mean, at least did a great job talking about it comes down to monetization of AI. And there, look, it started off Palantir, then you saw Datadog. Snowflake, I view as really a seminal quarter for the software.
Just describe what they do and why they're in the sweet spot right now.
So if you think about the data layer, what this is really showing is LLMs, as the models are ultimately getting deployed, you know, the data warehousing, who the middle layer. As companies go down the use case path, you need a Snowflake. So the point is that you're trying to now find companies in the second, third, fourth derivative who are actually going to benefit. You have chip players over here. You have the hyperscalers over here. In the middle is a Palantir, is a Snowflake, is a MongoDB. And I think what this shows, I call it the AI ghost trade. You can't just paint every company with the same brush, saying that Anthropic's going to destruct software. Snowflake's basically saying, you know, this is a Jalen Brunson-like quarter.
Just to sort of frame this in a more comprehensive way, when you take a look at Salesforce versus Snowflake, how do you identify a moat that is enough for a software company to be sustainable in an AI era?
Yeah, and Benioff, look, back against the wall, right? And you're talking about 150,000 customers. Now you have to show Agentforce clearly was what I view as a pretty big step in the right direction, but we're still talking 3-4% of revenue. It's not significantly moving the needle. Now you guys show over the next 2, 3, 4 quarters that they're able to monetize 15, 20% of the customer base. And that is right now, I wouldn't call it a race against time, but that's why there's so much pressure on Salesforce, pressure on Oracle, pressure on Adobe. Look what happened to Intuit. And I think that's why it's investors' winners bracket, losers bracket. CrowdStrike, Palo Alto, winners bracket on cybersecurity. Zscaler obviously got put in the losers bracket.
I'm just trying to figure out if there's some sort of generalities we can that we could make about what these brackets of the winners look like and what these brackets of the losers. I mean, I can have the Lisa bot do my taxes, which is why Intuit's struggling. You can potentially have different kinds of homegrown bots do a lot of the different functionality. You can't have somebody manage your cloud data in a comprehensive way, the way that Snowflake is going to do in tandem with Amazon Web Services. So is there some kind of characteristic of what the winning feature really is for software today?
It's one word, it's data. I mean, data is the new oil, the new gold. And who has control over that data, that's what's going to separate winners from the losers. Snowflake, front and center on data. Palantir, front and center on data. LLMs, the models, they're not going to commoditize data. They could commoditize pieces of software. We see a UiPath and some others. You see it on Intuit. So that's why investors are trying to figure out which bracket. If you're in this bracket, stock's up 30-35%, and I think going higher. On the other side, like a Salesforce, they need now to prove it over the next 6-9 months. And Benioff is used to being Mount Rushmore, you know, obviously at the top of the mountain. This is, I think, for the first time, a true test. I think they'll ultimately succeed, but this is definitely, you know, pressure environment.
So for Snowflake, if it was a Jalen Brunson quarter, was for Salesforce this like a James Harden quarter?
Oof. I would, and that maybe that would be a little too harsh, in the, you know. But I'd say
you just said he has 6 months to prove himself.
Yeah, look, I'd say it's one where if you look at Salesforce right now, they're in a situation where let's go. It's a Cleveland Cavaliers situation where, you had definitely green shoots, but now you got to prove yourself out. And I think Benioff understands the challenge there, what they need to do. But it comes down to investors need to see execution, monetization. That's going to be front and center.
What wouldn't you touch in tech right now?
Well, look, to me, I think you want
to sell. What would you avoid?
You want to continue to own chips. You want to continue in software. I think the areas, like if I look at where Adobe plays into it, I think IT services is areas you want to, right now, I think avoid in terms of, some of those components. And I think it's the legacy names, specifically in software and infrastructure, that you don't think that they're going to be able to turn around. I think it's truly a stock picker's market in terms of what we're seeing here play out.
Can we finish on Tesla? SpaceX IPO later this year. It's going to be a blockbuster, massive numbers we're talking about here. And then an additional sideline conversation whether Tesla becomes one with SpaceX. What do you think about that as an analyst?
I think that is, we've talked about it, it's the no-brainer move. We think 80 to 85% chance that we're sitting here a year from now, SpaceX and Tesla have gone down the aisle in terms of marriage. Because to me, that is one, in SpaceX clearly being from an IPO perspective, you had the XAI, integrated there. But when it comes to Tesla, from a data perspective, from AI, from an engineering cross-pollination, I think that's the grand vision for Musk. And I just continue to view this is a step process, but I think that the extremely high chance that that's emerged.
What does SpaceX get out of it?
Well, for them, you get the data, you get the engineering, you get ultimately what I view as autonomous physical AI, combined with what SpaceX bring, obviously, on the space and when it comes to Starlink and the foundation. And look, there already is cross-pollination between Tesla and SpaceX, but I think this would really be more of an official sort of combination. I think it's all part of the grand vision of Musk in terms of he's almost building out his own, just like NVIDIA and The Godfather, they're making stakes in companies. Musk has almost done it. You're really step by step here.
Dan, it's good to see you. It always is. Thank you, sir. Dan Ives there of Wedbush. You liked that, didn't you? What would you avoid? And he just started listing things he'd buy.
Yeah, what would you avoid? I absolutely buy chips. So thank you. Can I just say that Tesla owes Ferrari a thank you?
Go on.
Because when Ferrari comes out with their $640,000 car that was mocked roundly around this table,
sure.
I concede, everyone pointed to the high-end Tesla and how good it was, relatively speaking. And it was only $100,000. It was the best marketing ploy for Tesla you could ever imagine.
There was only one person I saw that said they liked this car.
Me.
Ian Bremmer. Well,
That's
no,
weird.
you were just trying to be controversial.
Why did he say he liked it?
He just didn't think it was that bad. I could go find the tweet, but he was like, I think it's like a good-looking car for an EV. The issue is, would you be willing to pay $650,000?
I think this is not complex. As a standalone vehicle, as a car, it's fine. Right? We can agree on that. As a Ferrari, absolutely not. $650,000, absolutely not. Right? And if it was 100K, I'm sure they'd sound loads of them. But the problem is it's got a Ferrari badge on it and not an Apple badge.
Which is the reason why you see people pointing to the Tesla and saying this only costs $100,000.
I agree with you, by the way,
and all of a sudden, the high end looks really good, and it has better, RPM or whatever the language is.
After Farrow got me into F1, Ferrari does not belong with an EV.
There we go.
Wow.
You found the tweet?
So Ian Bremmer says, first one in years that looks like you don't need to be an insufferable explicit to drive it.
Oh, that's a different sort of story.
Oh, come on. You can say the... Was that what he said?
Yeah.
OK, I think you can say that word.
Yeah, I don't think that's a... My nephew's watching.
I apologise to people at home. The problem is, with that statement, it's the lack of self-awareness there. Yeah. It will be the insufferable that actually buy the car.
Exactly.
You're going to see them in San Francisco and Los Angeles.
Exactly.
I think his failure to actually understand what one of those actually is. Anyway, let's give an update on stories worldwide this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. The Democratic Republic of Congo is seeking access to an experimental antibody treatment as Ebola continues to spread. The country's health ministry says suspected cases have climbed above 1,000, with 238 suspected deaths. Shares of Dell trading higher in the pre-market. The Pentagon says a unit of the company won a nearly $10 billion contract to provide a suite of software to the U.S. military. Dell reports earnings after the close. A Google software engineer is charged with insider trading. The 36-year-old allegedly made more than $1 million bet on Polymarket by betting Google's most popular search of 2025 would be the singer David. He had access to company data that tracked user searches when he bet. And that is your Bloomberg Brief. John.
Vonnie, thank you. I apologise. Is that a bad word? On my scale for profanity, that's just not, that doesn't register
My
at all.
17-year-old wrote it. He was like, oh my God, I've never heard
No,
that
he
word
didn't.
before.
No, I don't believe it. No way.
Oh my goodness.
No way. I remember when I first moved here and started cursing in the newsroom.
Yeah, that was.
Right, just throwing around the odd casual word. You know what it's like in London, right? Very casually, just sort of throwing in, lacing everyday language with profanity like an everyday Brit word.
Yeah.
And Americans being like, oh my goodness.
Oh, not New Yorkers.
Goodness. Oh my goodness.
I think you're allowed to say it also because it is a direct quote. So we want to be
There we go.
transparent and honest with our audience.
Thanks for cleaning that up. Appreciate it. Up next on the programme, counting down to inflation data.
Everyone is focused on core PCE. I'm worried about real personal consumption. Real personal spending at a moment in which nominal wage gains are not keeping up with headline inflation.
Up next, Kay Herr of JP Morgan Asset Management, live from New York City. You're watching Bloomberg TV. Inflation data a few hours away. Your scores into that look like this. Equity futures this morning pulling back after stalling yesterday, just about squeezing out a day of gains on the S&P. We're down this morning by 0.2%. In the bond market, switch on the board, 2s, 10s, 30s. Yields higher at the front end of the curve by about 2 basis points this morning, 4.06%. Under surveillance this morning, counting down to inflation data.
Everyone is focused on core PCE. I'm worried about real personal consumption. Real personal spending at a moment in which nominal wage gains are not keeping up with headline inflation means that consumers are losing ground in real purchasing power. And at some point, that starts to flow through to the broader economy.
So here's the latest this morning. Fresh data from the Federal Reserve's preferred inflation gauge due out in just under 2 hours' time, as more policymakers signal a hawkish pivot could be on the horizon. Kay Herr of JP Morgan Asset Management writing, it's a long way from an easing bias to an actual hike. We'll need to see signs of demand-led inflation to traverse that particular distance. Kay joins us now for more. Kay, good morning.
Good morning, John.
It's good to see you. I'm very well. Let's talk about this inflation data.
Sure.
What are you and the team expecting to see at 8:30 Eastern Time?
Look, let's start with, first of all, isn't it nice to not be talking about Iran and to go back to macroeconomic data?
Give it a minute.
I'm sorry, but every morning we wake up and it's like, you tell me what crude's doing, I can tell you what stocks and bonds are doing.
That might be the follow-up question, but please.
So look, I think that the inflation data has been very hot and very sticky. We've had a supply-side shock, and that's exactly what happens. It's going to translate through, and I would not be surprised if we get another hot PCE number today. And as you know, that's the Fed's preferred number. Is it going to be, the 3.8 consensus or higher or lower than that? I don't know. I don't have any insight on that. But I can tell you, almost guarantee that it will be higher than the Fed's 2% number that they're looking for.
How do you determine whether it's demand-led or whether it's supply-led? Right now, people talk about supply-led, but demand-led is allowing the inflation to remain hotter in the system because people are still buying.
So it's a good question. And the two things that we really focus on the demand side are wages and shelter. Those are the ones where we haven't seen it yet. We haven't seen, have you gotten, you don't have to answer this on air, but have you gotten a raise from Bloomberg lately? Jamie Dimon's not throwing out raises at JP Morgan. Like, there's just not a lot of wage inflation that we're seeing. Same on shelter. You saw a major M&A deal in the REIT market in apartments last week. There's not a lot of revenue growth for them. So those are the two things that we're watching and will continue to watch.
If you don't get some sort of rate hike, does that make you more skeptical about the long end of the yield curve? The idea that this is going to be a structurally more dovish
Whoa. You have
Fed.
Just gone like you guys were talking about Ferraris. You're in a Ferrari going all the way from not only might PCE
you just took away a raise from me.
But she's in a real Ferrari, not the EV Ferrari. Spicy this morning.
Well, I mean, look, let's be fair. This is the
I'm just
concern
trying to calm us down a little bit. Dan Ives is bright, colorful.
You're
I'm
wearing
in
black.
a somber black.
I'm wearing red. So let's go.
Okay, there we go.
There's a sense going forward that ultimately there is structurally higher inflation and the commodity shock isn't going away anytime soon, and that's going to lead to structurally higher prices along with the AI build-out. So at what point, without a rate hike, do you start to get more skeptical of long-duration bonds?
So let's take everything a step back here. First off, the Fed unfortunately ruined the word transitory for us because in 2020, to, they were talking about transitory, and inflation was not transitory. We were all out there spending, buying things, doing things. Inflation was not transitory on our side. You know, my colleagues, we were not saying that it was transitory. And that's put the Fed in a little bit of a box of they can't say it's transitory because nobody's going to believe them. They've lost credibility on that, right? And so now what are you seeing here? You see Fed officials moving behind, much more hawkish. And I think that's intentional. You know, in the 90s, we used to talk about the Federal Open Mouth Committee. I think we're back to the, do you not remember that? That's what it was. They're like jawboning about stuff. And guess what? The bond market is doing their work for them. The bond market is having the discipline. You worry about fiscal discipline. You worry about easy monetary policy. The bond market does the work for them.
But do you think it is transitory? Because the Treasury Secretary seems comfortable using that term.
Like I said, that word has been ruined, but yes, so far it looks very much supply-driven. What I can't tell you is how long it persists. The struggle is, I think people thought, especially after Venezuela, people thought Iran is going to be, we're in and out and it's fine, and it keeps getting extended. So I think the risk to it, and I have no insight on this, is the longer that this conflict stays on, the longer that gas prices stay higher. And then what happens? Does that continue to get passed through? You know, we've seen evidence that in the $4 to $4.50 range on gas prices for consumers, they substitute. You've started to see that the spending, the total dollar spending by consumers on gas isn't keeping up with what it should just purely based on what gas prices are doing. So consumers are trading down. You see it in retail on that. So if it's a year from now, then maybe things change.
What if it's the rest of the year? Conventional thinking is that the Iranians are well aware that the president has a big midterm election coming up.
That's a little bit hard to game. What I want to go back to is, you asked me a very good question a month ago, if I may.
Yay.
Last time I was on. No, you asked me, you were kind of baiting me on Warsh and trimmed mean. Did I accuse you of baiting me? You were.
Okay. I'm wearing red collar.
Right? So, and the Fed put out a paper last week on the measurement error around software services. You probably have not been on this, but the Fed themselves are saying that the contribution from software and accessories to core PCE is 9 standard deviations from the mean over the last 4 months. So the point is, when you look at something like trim mean, maybe that should get tossed out in terms of the influence that's having. So we're back to, what does this data mean? John, you're looking skeptical.
No, I just thought it was a really great effort not to talk about Iran there. The pivot.
I have no insight into Iran. I have no insight into Iran. I'm telling you, the bond market prices
Lisa said that continuously. I think a lot of people feel the same way, so they're looking elsewhere.
There's no edge. How do you get an edge on something that is a morass of disinformation and complication and difficulty, and it has a lot of human elements to it, but from a market standpoint, if you don't have an edge on it, it just is noise. It's like...
So that's exactly right, and you got to take it back to, what are we supposed to be doing? We're portfolio managers. We're supposed to beat the ag on a daily basis. So the first thing is, don't get whipsawed. You look at this market, there have been multiple opportunities to get whipsawed, and we haven't. Stay the course. You know, the bond market itself has gone from 2 cuts to 2 hikes and everything in between. Yep. We've had a more neutral view on that. We're going to be range bound, so you sell at the high, you know, you're buying at the highs of the range, you're adding duration there, and you're trimming it at the lows of the range. I mean, I just think it's that. And on the credit side, you know, while all the Iran stuff is going on, the IG bond market has priced almost $1 trillion of supply at a new issue concession.
Go. Kate Hurd, bullish bonds, JP Morgan. It's good to see you.
On the macroeconomic side, everything is going quite well.
A lot of that upside risk around the unemployment rate has moderated significantly.
We have some structural things building up in the inflation pipeline.
We still don't see the Fed hiking anytime soon.
The Fed is well positioned to wait and see.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg surveillance starts right now. And your scores, the price action looks like this. Pulling back from all-time highs on the S&P, down by 0.25%. On the Nasdaq, down by 0.5. In the bond market, yields creeping higher at the front end of the curve. Twos up by 3, 4.06%. Building off this move in the energy market. A small bounce on Brent and WTI. Brent crude this morning up by close to 3%, close to 97. Heading into this data point later this morning, 90 minutes away, PCE in America.
Yeah, so core PCE is expected to come in 3.3% year over year. That is not 2%. That is not 2.5%. It's actually above the 3.2% that it was in the prior reading, which is exactly the wrong direction and the wrong type of levels that this Federal Reserve would like to see. Does it matter? Is it transitory without saying transitory? This is going to be the key debate. But when you pair this with the robust earnings that we've been seeing from a lot of corporations, as well as ongoing improvement that you're seeing in the labor market, and you saw that this week with a little bit of peripheral ADP data, it seems to point to a direction that makes the Federal Reserve incredibly uneasy.
We've started every year for the last 3 years worried about above target inflation before the Federal Reserve has gone on to cut interest rates 3 times by 75 basis points at the back end of the year. I have to say this time, going into this summer, listening to these Fed officials, it feels slightly different.
Especially because ultimately there are a number of different nodes of this. It's not just coming from the oil prices, and we can talk about the Strait of Hormuz. It is very important. We all understand that we have to keep that in the back of our minds.
Can Anne-Marie have her moment in a moment?
But there is also the whole build out of AI. There also is this K-shaped economy where at the higher end, a lot of different retailers and travel companies are able to raise prices and pass that along, and demand remains robust. So you see it kind of trickling into the economy in different ways as we move from a financialized economy into a very physical one that suddenly needs to build for a new industrial revolution.
And a lot of that building, a lot of that spending, price insensitive. And that's part of the issue right now for this Federal Reserve. Anne-Marie's moment, it looks like this. Brent and WTI up by more than 2% so far this morning, call it 2.5. Moments ago, we heard from U.S. Central Command about just what happened in the last 24 hours. The second time we've seen this in just a few days.
Yeah, and the U.S. Central Command is saying that Iran launched a ballistic missile toward Kuwait, successfully intercepted by Kuwaiti forces, and then they're saying that it was an egregious ceasefire violation on the part by the Iranians. So then also the Iranians launched 5 one-way attack drones, and then those were near the Strait of Hormuz that then they struck down. So basically what we're seeing is tit-for-tat clashes. They're saying it's defensive in nature, but my question is, at one point, as we see these red lines really start to become pink, at one point do you actually say, no, this is proper end of the ceasefire, we might go back to attack?
For now, at least, and not to trivialize the moment, but I think the market sees this as expensive fireworks, expensive skeet shooting, so to speak, if you've ever done that, at a very expensive level on the US side. For the market, you nailed it, the word agnostic. The market is agnostic about how we get there, and there being energy flowing. And you've started to see some ships, some vessels get through the strait in ways that you haven't done a month or so ago.
Yeah, there have been a couple of vessels going to places like China, but also other places in the world. And every time you see a report, the greatest amount of oil that traversed the Strait of Hormuz going back to the beginning of February, suddenly you get another pop in markets because they're looking for just some leaks, to Anne-Marie's point earlier, that could allow oil to keep flowing and to mitigate some of the price increases that we've seen.
To that point, an Iranian news outlet is saying that Iran allowed 26 ships to cross the strait in the last 24 hours. I would love to know what flag these were, exactly where these ships are going. Also because last night, OFAC came out and basically sanctioned the tolling authority. And anyone that deals with that tolling authority is going to now be in the crosshairs of the U.S. Treasury Department, and they can also get fines and be sanctioned. So it's interesting to say Iran's allowing this, but it does seem like the U.S. administration is doubling down.
So we've got a bounce in crude, a pullback in equities of about 0.25% on the S&P 500, and a big data point dropping later this morning at 8:30 Eastern Time. Coming up this hour, we'll catch up with Emily Rowland of John Hancock, with stocks hovering near all-time highs. Bloomberg's Tyler Kendall with crude rising following fresh strikes on Iran, and the BNY CEO, Robin Vince, on the debut of the Trump Accounts app. Look out for that a little bit later this morning. We begin this out with stocks flat and crude elevated as investors await the latest round of inflation data. Emily Rowland of John Hancock writing, if the Fed must slam on the brakes by year-end, we are in the danger of the economy contracting. There is a tail risk where the bond market is starting to put in odds of 2 to 3 hikes. Emily joins us now for more. Emily, good morning.
Good morning.
That's the tail risk. Is it the base case?
It's not our base case. We think there's some underlying factors in the market that are actually disinflationary and have the ability to sort of offset this increase in oil prices that we've seen. But we're not in Kansas anymore, meaning we're not in Goldilocks anymore right now. And clearly we're seeing that, and the PCE data later this morning probably confirmed that. At the end of the day, though, we look at the sort of heat that's coming from inflation, but the macro picture is actually quite a bit cooler. Underneath the surface, things like housing data. We got Case-Shiller home prices earlier this week up 0.7 year over year. We're seeing job openings slowing. We look at real-time measures like Indeed.com and Linked Up, which are both showing that job openings are actually plunging as of the month of April. So I think when you look at the Fed's dual mandate, it's, employment and inflation. The employment side's quite a bit weaker than the inflation side.
In other words, you don't think the labour market is hot enough to worry. Is that fair?
That's fair.
Is the bond market a buy then?
To us, we are looking at every backup in bond yields as an opportunity because equities are priced for perfection in a world that's not that perfect. And as asset allocators, and we're making the decision between stocks and bonds, we see bonds as a value here. So we would lock in that elevated income and build a return stream that can last for years rather than sit in cash, which is what every investor that I talk to is still doing.
The issue a lot of people have is that financial markets seem to have broken down from the fundamental economy underneath.
Yeah.
There is a sense that some of the concerns and the weakness that you're seeing in certain pockets of the consumer, not seeing significant wage growth, doesn't matter for where inflation is, doesn't matter for where growth is. It's this price-insensitive buyer in terms of technology, as John was mentioning. And frankly, it's efficiency. So how do you kind of rebut that argument?
You don't. Nothing matters except AI, and
earnings.
And a little more AI. And it comes back to earnings. And it's funny, John said it, so I'm going to say it, this time's different. Those are the four most dangerous words in investing. I thought we grew up learning not to say
this
this.
time feels different.
It feels different.
I think.
He's caging it.
You're right.
A little bit of a
yeah,
little bit of
a
a caging there. It's a hedge.
But it feels that way in the sense that the economy's okay, but the market is just on fire right now. And we had, there's a number of things happening, but every single person that comes on your show is talking about earnings. And it was just absolutely explosive to see S&P 500 earnings coming in at 28%. Analysts had estimated 13%. That's great. 28%. And, it's the valuations are actually shrinking a little bit because the earnings are so good. The denominator is amazing and it's global. You look at emerging market equity earnings, of course, it's only 3 stocks. We all know that. But it's companies that are selling things to the United States from a semiconductor perspective that are also seeing their earnings booming. So we have used earnings as the number one input into our work for the last 10 years. And that tells you there's support for this.
Why can we see, or how can we see growth and these incredible earnings and incredible financial market gains without seeing incredible inflation? This is what I'm struggling with. And I understand what people are saying, which is that people don't feel very good. But unfortunately, this market is not kind. Averages are not kind. No. And they really cater to the upper end of the K, and the upper end of the K is feeling very good. Yeah. So how do you counter that?
Yeah, it's amazing. It's the wealth effect. Investors have never been richer and more miserable in history. You look at the Michigan Sentiment Index, and I understand why it's plunged, but it's at an all-time low last week. And meanwhile, the stock market's at an all-time high. It is remarkable. There's now $175 trillion in consumer net worth. People own more stocks than real estate for the first time since the late 1990s right now. So that wealth effect has been huge. And if you think about the way that it's all connected, you've got booming AI earnings. You've got semiconductors that are acting like they're sold out right now. So there's a scarcity issue there. There's a booming CapEx cycle going on. And then if you think about that wealth effect, it's translating into helping the financial sector, the wealth management businesses of some of these firms are booming. And then you've got, to your point, margin expansion for the first time in a while. Remember, we were worried about that for a while, company margins shrinking. Well, they're back to expanding again because companies broadly are using AI to do more with less. So there's a number of elements here that I think are supportive. Meanwhile, the lower end consumer, not so hot.
Well, at some point, the lower end consumer, they've been somewhat resilient, maybe having to move money around. Yeah. At some point, do they just have to stop spending?
I mean, it's certainly a risk. And, I've heard several economists say, we don't need jobs for the economy to grow. And I disagree with that. The more that you see the labor market deteriorating, where does that top line growth come from if people aren't spending? So I think that's a critical issue to watch.
So you don't believe in jobless growth?
I don't.
Wow. Okay. Because that's potentially where we're going with AI, right?
Yeah, I think it's going to, for now, so far, so good. And the labor market, by the way, is not falling off a cliff. Like, we look at initial jobless claims, we're still in the low 200,000s. That's great. But I do think at some point, if the unemployment rate goes up, that we're going to have a problem in terms of the consumer. But more important, if the market corrects. So then you're going to see that upper end consumer pull back. If you did see a 10% decline in the market, I think a lot of people are going to be looking at their portfolios.
It's funny how few people put any weight on you, Mitch, and that sentiment number being at record lows. And understand why, because I think typically we look at it from the following perspective. How on earth can this be worse than GFC, being locked up at home in a pandemic? Allow me to try and shift the perspective just a little bit on that number. It's not about viewing this economy in isolation right now. I think you should view that number as an accumulation of feelings over the last couple of decades, the accumulation of feelings through GFC, through the pandemic, and the consumers and what they felt about this economy. It's not just about now. It's about then, where they were before. And for them right now, yes, it's got to that point where it's never been worse because prices still keep climbing. Now, yes, sure, 3% is not 9%, but that doesn't matter. It's on top of the 9% before. So you're looking at a basket of goods that might be 30% plus higher than it was going into the pandemic. And it keeps getting worse, not better.
And if you're 30 years old today versus a 30-year-old in 1990, could you buy a house? Could you have confidence about what your job would be? How do you develop a family? There are all of these huge questions, which is a reason why that long-term interest rates matter quite a bit. At the same time, averages are not kind. I keep coming back to that. And if you have hyperscalers spending on incredible goods and paying $100,000 bonuses every week, well, suddenly there's a cohort of people that can still afford these things. It becomes a policy issue on the fiscal side, not necessarily a policy issue on the monetary side.
Emily, it's always good to see you. You're going to stick with us. Emily Ronan there of Jan Hancock. Emily was talking about EM. Take EM. She mentioned 3 stocks, right? You ask people in emerging markets right now how they feel. I'm sure they're struggling with access to energy at the moment. They probably don't feel very good. But that's not the emerging market stock story right now. The emerging market stock story right now is Taiwan Semi, SK Hynix, right? And Samsung. 3 names. That's the story.
It's not exactly diversification from some of the winners that we've seen, which is sometimes people come on and they say, we like EM, but we like the EM names that are sort of the ones that are traditional, that have actually gotten their balance sheets together. Maybe you developed markets could learn something from them.
We'll spend some time on this story in just a moment. Let's get you an update on stories elsewhere with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. U.S. officials saying Iran violated its ceasefire agreement with the U.S. In a post on X, Central Command calling Iran's launch of a ballistic missile toward Kuwait a, quote, egregious violation. Dollar Tree shares surging in the pre-market. The discount retailer reporting first quarter earnings that beat on the top and bottom lines. Dollar Tree also boosting its adjusted EPS forecast for the year, surpassing Wall Street estimates. Meta is rolling out a paid subscription model for its AI chatbot as it aims to offset big spending. The tech giant is unveiling a 2-tiered subscription model at $7.99 per month and a premium plan for $19.99. It's being introduced in Singapore, Guatemala and Bolivia, with plans to expand to more countries. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. I'm next on the programme, trading strikes at the Strait.
Iran is very much intent. They want very much to make a deal. So far, they haven't gotten there. We're not satisfied with it, but we will be. We will be either that or we'll have to just finish the job. They're negotiating on fumes.
In just a moment, we'll catch up with Bloomberg's Tyler Kendall from the nation's capital in Washington, D.C. From New York City this morning, good morning. Fifteen minutes away, this conversation right here. Looking forward to catching up with the BNY CEO, Robin Vince, at 7:30 Eastern Time. Don't miss that in just a moment. Don't miss this either. In an hour and 14 minutes' time, inflation data in America. PCE, the Fed's preferred read on inflation, expected to climb to close to 4%. The estimate for this morning, 3.8% year over year. And every single Fed official we've heard from so far is worried about upside risk to inflation.
I keep asking, and I kept thinking about this last night as I was going over some of the commentary from Jefferson and Cook, the Fed officials who were talking about the potential to raise rates. Who exactly wanted to keep the easing bias in the Federal Reserve? Ultimately, this is not what we're hearing in terms of the rhetoric. Clearly, the numbers aren't doing so well. We're going to be dissecting them. And Kate Herr actually did have a really good point, which is ultimately there are some inputs here that might be skewing things. And so a trim mean might be looked as political. At the same time, economists that are well-versed in markets are looking at this.
There seems to be a conversation, speculation, if you will, that maybe this was about just setting things up for the new guy to make the decision himself, not to take it away from him. Maybe. And I have to say, so far the data backs that up, because to your point, and you're absolutely right, I can't point to a single Fed official right now that does support the easing bias at the Federal Reserve. So who did at the last meeting?
And if they did it and they aren't going to come and say it, well, then what good is some of this easing guidance to markets? Right now, how much is the Fed trying to do with job owning and how much are they actually willing to do? And that right now is the debate for bond markets.
So we've got some data and some earnings too. Later this morning, we'll get numbers from Costco. After the closing bell, we'll also hear from the Gap as well. Look out for Dell after the close as well. Some of these old school tech stories really taking off recently, so look out for that name too. In the commodity market this morning, we're bouncing back on Brent crude 97, WTI around 91. Under surveillance this morning, trading strikes at the Strait.
The Strait's going to be open to everybody. We'll watch over it, but nobody's going to control it. That's part of the negotiation that we have. Iran is very much intent. They want very much to make a deal. So far, they haven't gotten there. We're not satisfied with it, but we will be. We will be either that or we'll have to just finish the job. They're negotiating on fumes.
So here's the latest this morning. The US and Iran exchanging fire in the Persian Gulf. Within the last hour, US Central Command saying Iran egregiously violated the ceasefire agreement. Bloomberg's Tyler Kendall joined us from Washington for more. Tyler, we saw the reports over the night. We're now getting some detail of what just happened in the last 24 hours.
Right, John, breaking moments ago, this statement coming out from CENTCOM saying that this egregious ceasefire violation on the part of Iran comes after the country launched a ballistic missile towards regional partners like Kuwait. And CENTCOM goes on in its statement to say that CENTCOM stands behind regional partners and remains in part, quote, vigilant and measured as we continue to defend our forces and interests, not taking the threat of further military escalation off of the table after overnight the U.S. conducted this freshest round of military strikes in response, according to CENTCOM, to multiple drones being launched at commercial ships in the Strait of Hormuz. And just yesterday, President Trump maintained that no country will have formal control over the Strait in any potential deal that the U.S. signs. But we're starting to see Iran try to tighten its grip in multiple ways, including laying mines in the Strait, conducting these drone strikes, but also releasing this new set of rules that vessels would need to comply with in order to transit through. And new this morning, we heard from Iranian state media that confirmed that so far the country has let through 26 vessels in the last 24 hours and says that the IRGC is vowing that they will respond to any disruption to its efforts to try to control traffic in the Strait. This is just raising the risk here and showing us how, at least publicly, the two sides feel very far apart on what appears to be the first phase of any potential deal. John, we know that the White House is pursuing this phased approach where we would first need to see a reopening of the Strait of Hormuz before we can even talk about formal dialogue around what potential curbs on Iran's nuclear program would look like and what happens to that stockpile of highly enriched uranium.
Tyler, appreciate it. Tyler Kendall down in Washington, D.C. Everything's lined up to squeeze this consumer right now. The labour market's not too hot. Energy prices at multi-year highs. Mortgage costs at about 6.5% for a 30-year mortgage in this country. But some retailers are executing. Best Buy this morning up in the pre-market, Lisa. Earnings just moments ago. The stock is up by more than 9%.
Yeah, it came out with first quarter revenue of $8.94 billion versus the estimate of $8.8 billion. If that had been NVIDIA with $1 trillion next to it, it would have been absolutely penalized because stocks have been bid up so much. But because it's Best Buy and because people have been so skeptical of the U.S. consumer, stocks are surging some 9.5%. You're seeing just the maintaining forward guidance, and that is enough. Similar story for Kohl's, reporting stronger than expected sales, but just talking about less of a loss than people had previously expected. That's enough to send these stocks surging. So it gives you a sense of just how much people have a very low bar for consumers, cyclicals. And if that starts to change in any capacity, that will be rewarded in a significant way.
Best Buy up 10% at the pre-market. Emily Rodent of John Hancock still with us. Emily, let's continue this conversation. Earnings. Can the earnings story broaden out beyond just these select chip names in the tech sector?
Well, you're seeing it, and I think this morning certainly is evidence of that. But it almost does feel like the entire stock market is becoming an AI stock market. It's bleeding into small caps. It's bleeding into mid caps. One of the things that surprises a lot of the investors I talk to is that value is handily outperforming growth this year. Guess why value is outperforming growth? Guess what's in the value index? Semiconductors. It's Micron and Intel are the top two names. So the value factor is wildly outperforming. It's the combination of value and momentum. That's kind of an odd couple, if you ask me. And meanwhile, low volatility and quality are way behind year to date. So very interesting dynamics. If you're somebody that's doing asset allocation or doing attribution analysis, there's a lot of surprises under the hood there. And there's a know what you own, I think, element to the market.
What do you think is more durable of the things you've identified?
Yeah, I mean, I think quality can come back here, typically in an environment where economic growth is slowing. And I'm not saying, again, economic growth is significantly slowing in the United States. I don't think it is. But I do see this modest deceleration that typically benefits quality, that typically benefits growth, that side of the market. So I do think we could see a handoff here if that continues.
The signal here is that people are looking for buys. People are looking for steals. They want bargains. And I'm not just talking about going to Kohl's and looking in the sales rack. I'm talking about the idea that Kohl's shares are down 36% so far year to date. So when they come out and they maintain forward guidance, that's enough to send the stock to the races. Best Buy down 3.5%. When they maintain guidance and have a little bit of a beat, people are just cheering. Is that healthy or is that concerning?
I think it's okay for now. I think the challenge is obviously there's a tax on the consumer right now in terms of paying at the pump. And meanwhile, you've got wage growth at a pretty meager about 3.5%. Just a few years ago, wage growth was like 6-7%, much higher than inflation. So I think the consumer is starting to get pinched here. We do have some advantages versus a few years ago. Obviously, the energy independence in the United States is something that's helpful. We have the electrification going on. I wish I personally had an EV. I didn't make that investment a while ago, but that certainly would help. So there are some offsets here, but I do think the consumer can start to come under some pressure in the back half of the year. And that's really important as it relates to how much risk-taking there is in markets today.
How exhausting is it to maintain your cautious stance?
It's exhausting. So the dip buying is just absolutely relentless. And you and I have talked about this. It's the retail investor that's just so powerful. And I think you're seeing it in momentum. You're seeing it in technicals. The best investors this year have been my 16-year-old son and the rest of his friends on the Marblehead High School lacrosse team, because they all have, they're all trading every day and they're all very busy with their, the strategies that they've learned on TikTok or whatever else. And it's frustrating when the team is beating me at the investing game. So I think it's a challenge. We're being put through the ringer, but at the end of the day, I think fundamentals will matter again. Earnings will matter again. Quality will matter again. We may just have to wait a bit.
I wish we had more time, because I was just about to lean in and get ready for what sounded like a therapy session between two mums, both of which are bearish and both have very bullish sons at home who are very long this equity market.
I have to say that we were talking, my son, in March when the NASDAQ was down some 1%. Mom, I bought the dip. I went all in.
See? You were like, son, but what about the straight and the price of oil?
Exactly. And I said to him, Anne-Marie tells me about the straight all the time. And he said, you don't get many dips. And he crushed it. And I feel like we're in the same boat.
We saw this in the pandemic, right?
I know.
The same thing. They got long early, and they were right.
Yeah.
And they were right too.
Yeah, they're conditioned to be bullish. And so if you have a whole generation conditioned to be bullish, do you fight it? Do they get reconditioned at some point? I mean, these are some of the
What's
big questions.
What's the phrase we love? The less you know.
The less you know.
The less you know, apparently. Emily, it's good to see you.
Yeah.
Thank you. Emily Rowland there of John Hancock. Up next, the BNY CEO, Robin Vince, on the debut of the Trump Accounts app. Look out for that in just a moment. Plus, Yahira has your morning movers. Dollar Tree rising following a strong earnings beat. They're not the only ones this morning. Dollar Tree up by 11%. Five days, no losses on the S&P 500. Equity futures pulling back just a little bit. That might change today. We're down by 1/3% on the S&P 500. On the Nasdaq 100, down by 0.5. Plenty of decent retail earnings stories out there. We'll spend some time on that in just a moment. Turn to the bond market, though. Front end of the yield curve in focus going into this PCE read. The inflation read at 8:30 Eastern Time, the Fed's preferred read on price pressure in this country, 4.06% on twos and up 3 basis points. The move in crude this morning not helping. WTI and Brent bouncing just a little bit, up by close to 3%. Brent at 97, WTI at 91.
When you pair the higher prices with some of the earnings that we've gotten from retailers that have been fairly robust and some of the forward guidance, which has been either maintained or upgraded from a number of different retailers, it gives you a sense of how inflation can be sticky. Whether the Fed will actually hike rates is an interesting question, because right now, the front end of the yield curve pricing that in, so many people don't believe it. Stock market investors don't believe that the Fed will have the will or desire to raise rates. Bond investors don't seem to think so either, and yet the bond market's pricing it in, so try to square those two ideas.
It's a weighted average. Very unusual for the Federal Reserve just to come out and hike once, which is basically what we're priced for. So there's a risk they do a lot more than that if they start. And there's a sequence they have to go through. As you know, it's a delicate dance, it's very slow. First of all, you remove the easing bias, you slip into neutral. Then you start saying things like, there's an equal chance of a hike or a cut, we don't know, let's get more data. And then you start to think about whether you really need to hike rates. I don't think this Fed hikes 25 if it starts to hike. It's going to do more than that. In the same way it doesn't cut 25, it cuts 75. You know, if you're going to do one, you'll do 2 or 3. So for them to start really thinking about signaling that we're going to hike interest rates, I think they've really got to believe you need much tighter policy than where we are right now.
Well, the rhetoric is outpacing maybe their willingness to move, because the rhetoric is actually increasingly shifting toward the possibility of a rate hike. And that easing bias I can't find in the rhetoric, even though I saw it in the document. So it is going to be a curious mix that, good luck, Kevin Warsh.
I guess they're hoping it does something to tighten financial conditions and ultimately they don't have to do anything.
As a market representative, sick of being jawboned, whether it's by the straight or whether it's by this. I think there is a sense of people just looking at the data and trying to make decisions.
The earnings, and they're absolutely fantastic.
Earnings.
Yes, every single time. Let's talk about it. 2 hours away from the cash open, your morning movers, Yahara has more. Hey, Yahara.
Hi, John. Well, these retail earnings have been fantastic, and we start with the standout. Dollar Tree shares are rising 9.6% in the pre-market, and it's perhaps no surprise that a name like Dollar Tree is seeing strong demand as we continue to see signs of a more price-conscious consumer. It posted a beat and a raised quarter, and what's interesting is that it was still able to improve margins even with tariff pressures in the backdrop. And no, it's not because it's raising prices, it's because of less theft and better shipping costs. And interestingly, while you're seeing a stretched consumer trading down, you are also seeing them able to splurge on pricier consumer electronics items. Best Buy shares are up 10% in the pre-market after it posted better than expected results and just reaffirmed its full year outlook. And as Lisa said, there's just been so much skepticism around the U.S. consumer, so this is enough to lift shares. And we end on our big mover to the upside, and that is Snowflake. Shares are still up nearly 40% in the pre-market after the cloud software company raised its full-year outlook and announced a massive $6 billion deal with Amazon Web Services. This is clearly a relief for investors who have grown increasingly worried about AI disrupting software. John.
What a move. Yahara, thank you. Appreciate it. More from Yahara in the next hour. On our radar this morning, U.S. Central Command saying Iran violated the ceasefire agreement, launching a ballistic missile towards Kuwait. The attack coming hours after Iranian forces launched 5 one-way drones near the Strait of Hormuz. The missile and drones were all intercepted. Elsewhere, a fresh round of retail earnings out this morning. Dollar Tree shares soaring after increasing its full-year outlook. Kohl's and Best Buy also rising. Both retailers reaffirming their guidance. Earnings continue after the close, with Costco and The Gap set to report. And finally, Fed officials continuing to warn about rising inflation ahead of today's PCE report.
The risks remain tilted toward higher inflation. In my baseline forecast, disinflation should resume in upcoming months without having to raise rates.
I believe this policy stance leaves us well positioned to respond to economic developments based on the incoming data, the evolving outlook, and the balance of risks.
The Fed's preferred inflation gauge expected to climb closer to 4% today, marking the biggest 2-month acceleration going back to 2021.
This is clearly Fed officials taking it into their own hands to remove their own easing bias. You heard Lisa Cook, for example, saying inflation is clearly moving in the wrong direction, a similar type of tone from Jefferson. A question here about the delta between removing the easing bias, having hawkish rhetoric, and actually hiking rates. This is a chronically dovish Federal Reserve, and unless there is some external factor, it is unclear what could prompt them to be different and to actually be proactive in hiking rates at a time when there clearly is a lot of distress in certain pockets, even if the overall averages seem to be climbing.
So this conversation that you and Jonathan have been having is maybe this is off to offer almost a clean slate. Kevin Warsh needs to come in and be the one to make that decision. If it's not him, who else is on the Fed to really take the reins? Or also any individual there that thinks potentially they would want to keep it if Stephen Myron is the one that maybe is the only individual that was going to want to keep the easing bias. Because maybe Kevin Warsh would want to.
Rip the Band-Aid off, new regime, hike rates, June 17th.
Yeah. No way.
Right? Just total reset.
Base case.
Who would accuse Kevin Warsh of sacrificing central bank independence if he hiked 25 basis points on day one?
Everyone when he gets fired, when he gets canned by President Trump. No one's expecting that, but he can rip the Band-Aid off and move to a neutral position, which is really interesting. Also, we'll hear from him. I mean, again, who is the real Kevin Warsh?
We might find out in the news conference on June 17th. Stay tuned. Got some cool news for you. The Treasury Department launching the Trump Account app today in collaboration with BNY and Robinhood, the partnership between the public and private sector aiming to expand access to long-term investing for American families. Robin Vince, the BNY CEO, writing, "We're bringing together the administration's vision and leadership, Robinhood's digital accessibility and BNY's infrastructure." Robin, I'm pleased to say, joins us in studio for more. Robin, good morning.
It's great to be with you.
This is a very cool day, so let's spend some time on this. So you do the back end and Robinhood does the front end.
Yeah, we're the financial manager, and Robinhood is bringing all of their expertise in the front end, as you point out, the app, and don't forget the National Design Studio as well, because they've partnered with the Treasury Department, with BNY, with Robinhood to make sure, as part of the administration's push, to make services more accessible and easier to use in the U.S.
What are sign-ups like right now ahead of this?
So 5 million accounts, people indicated interest in the IRS Form 4547. So that was the first step. You had to actually register interest. And once you've done that, you can go to trumpaccount.com, which will actually then take you to the App Store. And then as the App Store rankings grow, you'll see it easily pop up on the App Stores. And then you can download the app, and then you can actually register and actually put the rest of the information, get up and going. Now, the actual program for investing the money doesn't actually launch until July 4th. So these are ready, set moves ahead of the full go July 4th.
What does this mean for the future of BNY? Will you make money off of this, or this is solely for the public good?
Well, we believe in the program. I think that's really, if you step back from this whole thing, what is the public policy? So the administration really deserves a lot of credit. President Trump, Secretary Bessent in particular, the leadership of the Treasury Department in driving this forward, that actually creates the framework to be able to have everyone in America be able to participate in growth. And so we provide, as a company, a bunch of different services to the U.S. government. We do it at the state level, the local level, and at the federal level. And so for us, we're frankly just proud to be able to participate in this. Of course, as part of providing the service, we're doing a bunch of different things, so are Robinhood, but it's the public policy that we are most focused on here. What else have we done? Well, we were the first financial firm to actually offer matching into the program. So remember how it works. Everyone kid who's born in America, the parent or guardian get to be able to put $1,000 in if they want as matching, or they can put additional money. The government's going to put $1,000 in. Employers can match. We've matched with the program. And then we're really leveraging the power of compounding. And this is the magic of the program. Just let's do the math for a second. $2,000 in right at the beginning, $1,000 from the government, and let's take the example of a BNY employee, $1,000 from us. Now you've got $2,000. You compound that with the historic rate of return in the stock market over the past 30 years, compound that for the next 30 years. And in 30 years, that kid will have $40,000. Now, if the parent added just another $10 a week into the same program, $10 a week that they're putting into that same account, now you'd have $140,000 at the end of 30 years. Now that's real money. That's participation in the American dream. And I think that's the program and the vision that the administration and the Treasury Department
Sounds like almost an incentive to have a child in America at this point. But when you think about post-Trump 2028, does this have longevity? Will it continue, say, a Democratic president won?
I think great public policy, and again, stepping back from it, what is the policy? The American dream, and what a time to be thinking about this, the 250th of America. The American dream is one of the things that's fueled this country over the course of the past 250 years. But we have a problem, which is not everyone is participating in the American dream. And so now you're talking about taking the 40% of people in America who have zero stake in the equity markets and actually making them stakeholders in the American dream and doing it from birth. So the ability to do that, to be able to grow, compound, participate, learn how to invest, learn how to be part of the capital system that we actually have, that's a really important piece of public policy. And so none of us can predict the future, but this has been a bipartisan effort from the start. There have been folks on both sides of the aisle who've joined into this. There have been wealthy philanthropists like Michael and Susan Dell who've said they're going to match. Employers like us are matching. I'd encourage all employers in America who are able to do so to be able to offer matching to that initial seed investment. And collectively, if we can increase this participation, we're really growing participation in the American dream. And I think that is why it's a great piece of public policy. And so I'd really hope to see it be able to continue.
It also potentially improves the delta between people who feel really disenchanted by Wall Street and feel like Wall Street's really let them down, as a number of people get very wealthy and they aren't necessarily getting wealthy. I just wonder what the guardrails.
The point, Lisa.
Yeah, so to try to say, like, well, you can participate too.
Absolutely. What sort of American dream is it if we have a bunch of people who aren't participating in it?
I just wonder the ideal versus the reality. When I think about a Robinhood account and then I think about a teenager or some kid who has access to it, I think about my own experience, which is essentially it's very high-end gambling, but essentially gambling, right? I mean, it's essentially turning into trying to pick winners and losers. How do you know that that's not going to be leading to people going and saying, we're going all in on GameStop, here's your future?
Well, I think this is the key to the design. If you step back and think about what is it that Secretary Bessent and the Treasury Department, when you actually get into the brass tacks of how it works, you're talking about a custodial account. So for the right to start with, the kid can't touch it until after they turn 18. So there's no opportunity to be able to take the money out and go and spend recklessly. Now, once they become 18, that's the law of the land. They own their own future to some extent.
GameStop all the way.
But up until then, it's primarily about index funds. So the initial investment will be index funds only. So people aren't having to make choice about individual stocks. They're participating in the US stock market. They're participating in the growth of the economy. And that's actually the design principle at work here.
You've got to acknowledge where the YOLO trade comes from. The YOLO trade comes from this idea that they're not participating, that the only way to benefit from this economy, because they feel frozen out from the gains, is to take these high-stakes risks. So in some ways, this is a long-term goal to do something about the kind of thing that you're complaining about.
Yeah. 100%, and to potentially equalize people who feel completely left out and are earning minimum wage as other people do nothing and watch their money grow and create income. And this is sort of the gap that you need to bridge in order to create a little bit more of, the market and the economy can move a little more together.
Robin, I just feel like we're losing the argument at the moment. The arguments on the left and the more populist arguments seem to be winning this moment. We see this in our UK. The shift towards the left and the politics of Labour more recently. We see it here in New York City, the heart of capitalism, and a socialist mayor got elected in this city. What else needs to be done to counter some of that, to make sure that people recognise the benefit of free markets and capitalism, the very idea that we've seen this mass affluence in this country because of those things?
Well, I think it is about inclusion ultimately and having people be able to participate. So let's go back for a second to this concept of the American dream and let's define it. What actually makes up the American dream? I'm an immigrant into the US. I've lived here for 25 years and very excited to be able to be part of this. And if you think about folks here in the US, what do they aspire to? They aspire for a great life for their family. They want to be able to have a great education. They want to be able to grow. They want to be able to have their own home. And so what I think Trump accounts represent is one piece of the American dream, which is the ability to have a stake in the country, a stake in the capitalist system. And so to your point, it helps to include that 40% of people who today don't. But there are more things. It's not by itself the solution. Financial education matters a lot. That is actually part of the app, if you actually look at the Trump account app. Financial education, because we've got to recognize that saving, investing, starting early, compounding, you were just having that conversation, the value of money over time and the value of what it means if you start early, those make a difference. But housing matters as well. Owning your own home over the past 50 years has really become part of what a lot of people define as being part of the American dream and being able to enjoy that. So as a company, we've taken a step in that direction. About a month ago, we announced a new program at BNY, which is to help people get that first step on the ladder. If you work for us and you earn less than $100,000, we will actually give, and you're buying your first home, we will give you the equivalent of $5,000 after tax to be able to help you with your down payment. The average home in America, median price about $400,000. Our largest office is actually in Pittsburgh. There, the median price is about $250,000, $300,000. We've got one of our largest growing offices is down in Florida. There, the median price is about $400,000. The average down payment for that type of home, call it about $30,000. Now, there are government assistance programs for first-time home owners that are available. And so depending on where you are, that might be $10,000, $15,000, even $20,000 assistance. But you're still left with a gap. $10,000, $15,000. So for us, that $5,000 is bridging either 50% or a third of that gap for the prospective homeowner, so they can get their step on the property journey of the American dream. So those things really matter. Now, we're doing that with Bank of America, who's our partner. They're providing subsidized mortgages to our own employees.
Brian's big on this, I know.
He is, and he's also leading on this point, which is leaning into the topic. How can we actually help? Financial education. So if you can give people, through the Trump accounts, a stake in capitalism over time so that they're part of it and don't want to have to throw stones at it, and you give people a leg up on the property dream, now that's inclusion and bringing people along the journey. And I think, again, back to America 250, what a time to be focusing on this.
Robin, you're going to stick with us, I'm pleased to say.
Yeah.
It's good to see you. Thank you, sir. Robin Vince there, the BNY CEO. Let's give you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thanks. Ukraine President Volodymyr Zelensky rejecting a partial membership in the European Union, arguing the country deserves full membership because it's defending the bloc from Russia. Zelensky responding to German Chancellor Friedrich Merz's suggestion that Ukraine be granted an associate membership. Congressional Democrats losing a bid to block the Trump administration from prohibiting mail-in voting for anyone not on a pre-approved list of citizens. A federal judge ruling the legal challenge to President Trump's executive order is premature because the restrictions aren't in place yet. And Best Buy rising in the pre-market after reporting better than expected earnings. The retailer is seeing the most growth in gaming and computing. Best Buy previously announced CEO Cory Barry will step down later this year and Jason Bonfig will take her place. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in the next hour. Up next on the programme, a generational change in the workplace.
Businesses are adopting AI at an increasing rate, but many have not yet used it to change the way they organize work. We could be approaching the most significant reorganization of work in generations.
Up next, more with the BNY CEO, Robin Vince, live from New York City. You're watching Bloomberg TV. I'm going to do this because Robin won't, so check it out. 5-year chart, BNY. All right? Look at that dip around 22. When did you take over? August 22?
September 1.
September
22.
1. OK. We're trading in the 40s. And now we've had a 200% plus gain on that name. You're never going to say this, but your bank is the best performing bank stock over that period out of all the major banks on Wall Street. What have you and the team been doing to get that chart to go up and to the right so aggressively over the last few years?
Well, first of all, look, I'll credit we're 242 years old, right? So we've been around for a little while. And what does that mean? We were here from the start. Again, in America 250, it's kind of a fun story over time, the evolution of the bank. But we had a terrific set of businesses, and those had been accumulated over a period of time by my predecessors. What this leadership team has done, and our broad company has done, is we've recognized the power of what we have. We have a great set of businesses, we have an incredible client franchise, and we decided to put culture at the heart of a transformation. And so we've invested in coming together as one company to really run the company differently and then to show up differently for clients. So we've had a commercial transformation, we've had a platforms transformation, but more than anything else, it's been a cultural reimagination of our company. And it's incredible what you can do when you bring a group of people together with like-minded, with purpose, intensity, and you really go for it and you deliver for clients. And that's the result.
And now you've got the technological revolution to layer on top of that in AI. So I'm going to ask the cliche interview question. How do you see your next 5 years? How do you see the next 5 years? What does it look like? How different is it going to be?
I'm an AI optimist. I think this is a revolutionary technology that for sure has to be well managed. It has to be put in well. It's difficult to be able to adopt AI in an established company, for sure. So people talk about clean sheet of paper, sitting in the garage, you can reinvent anything. Absolutely. But wouldn't you prefer to have a clean sheet of paper philosophy inside a company that already has great assets? And then you have the best of both worlds. And so that's the way that we see AI. We see it as a superpower that will help us to be able to run the company better, that will help us to be able to really do more things for our clients, improve our products, and ultimately be able to just do new things as well. It's a capacity creator. And so there's a lot of doom-mongering around AI. And I understand none of us know exactly how the world's going to unfold. But, you know, back in the day, all of the folks who were stable hands and who ran horse and carriage businesses, I'm sure they didn't love the creation of the motor car. But they also couldn't imagine that there would be new professions and trades that were built around that new industry. And guess what? There are now more jobs. They're just different jobs, and they've evolved.
So Robin, you don't see AI as replacing lower value human capital. That is what one of your colleagues
Not one of
said.
my colleagues.
Well, peers.
I understand. Again, there's an aspect of thinking about AI, and I think he has walked back those comments, but I think there's an aspect of AI where you can get all pessimistic and negative about it. For sure, it's going to make some roles unnecessary. And so there's a reskilling that's very, very important. And as leaders, we have to own that. We have to own that at the government level. We have to own that at the company level. We have to have some individual responsibility around increasing all of our AI IQ. If there's a new technology and you don't know how to use it, and you don't care, and you want to hide from it and wish it got uninvented somehow, I mean, to me, that's fantasy land. It's about how can you accept the reality of the fact that it's here. There's no great technology that's really ever been uninvented. And so we might regret the creation of AI. That's an individual sort of point of view. Free country, everybody can have their own point of view. But the reality is it's here. So I would prefer, and certainly what we're doing in our company, is to just deal with that reality, get into it, and try to equip everybody. And I think this is a public-private sector. We started off talking about Trump accounts, the public and private coming together to enable good things for the United States. I think AI is the same thing. It requires public leadership, it requires private leadership, and coming together to upskill people for the future.
30 seconds left. Will the intern class at BNY be bigger or smaller in the next few years?
We've tripled it since 2022. You put that chart up of what we've done. We've tripled our intern and analyst classes over that period of time. And because we think that's a cohort that is naturally AI inclined. And so we want to continue to bring these new skills, these fresh people into our organization, but we also want to equip our existing team. So we've rolled out 170,000 hours of AI education last year. We're doing a full week of training for what we call AI pioneers to be able to get people to be super proficient so they can build agents, use our platform across the company, Eliza. That's the future for us.
We'll be joining the class. Robin, it's good to see you. Appreciate it. Thank you. Robin Vince there, the BNY CEO. Equity futures this morning, slightly softer. Up next, we'll catch up with Katie Kaminsky of Alpha Simplex, Sucharita Kodali of Forrester, Matt Lazzetti of Deutsche Bank, Matt Stuckey of Northwestern Mutual Wealth Management. Inflation data 34 minutes away.
This cycle has been very much infrastructure CapEx driven.
I do think you favor tech here.
We're bullish on the S&P, but we're probably even more bullish on this rally broadening out.
The basic thrust of the market is to go higher.
Missing out on the upside is like participating in the downside.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your price action, the scores look like this. Pulling back, we've gone 5 days without losses. we're looking like we might not be able to stretch that to day 6, at the moment at least. We're down by 0.25% on the S&P. On the Nasdaq, we're down by 0.4. In the bond market, setting the tone for some of these moves. This move right here, up 3 basis points at the front end of the curve, 4.06%. Crude pushing yields higher. WTI and Brent. Brent crude up by close to 3%. Let's call it 97. And setting the tone for the rest of the trading day might be this, another read on inflation at 8:30 Eastern Time.
It's expected to come in hotter than the previous read at 3.3%, well above that 2% level that is the bogey for the Federal Reserve. Remember, this is the key inflation metric that the Federal Reserve tends to look at for now. That could change going forward. At the same time, it's sort of underscored by some of the earnings that we've gotten from retailers that continue to show that despite some of the higher prices consumers are spending, even Dollar Tree, which has dollar in its name, it means it has a higher price point and it is seeing people still come through their doors. So this gives you a sense of how there is a stickier inflation even amid some pushback at the lower end.
This print's going to be really important. It's going to be the start of the journey, really, for the Federal Reserve, potentially, possibly, most likely, at minimum, to remove the easing bias when it comes to how they're feeling, especially after what we've heard from all the Fed officials, that the balance of risk now is to both, and they do see this concern when it comes to inflation.
$2 tree doesn't quite work, does it? Doesn't quite have the same.
$2.99 tree.
$2.99 tree.
$15 tree.
Your point on the easing bias, by the way, and if you're just joining us, welcome to the programme, I think Lisa made the point of the morning. Think about all the Fed speak you've heard in the last few weeks. Can you pick one person that supported the easing bias of the Federal Reserve? Which is curious because the data hasn't changed in between that meeting and where we are today. We haven't seen anything that would change anything at all. So what did they discuss at that meeting that kept that bias in that statement?
So there are a couple of potential options. Number one, they wanted to give Kevin Warsh a clean slate, as you've been mentioning. Number two, they want to jawbone the market into a more hawkish position to do the work for them so that they don't have to consider hiking rates. But they are getting on board with the idea of potentially removing the easing bias, but they still are all biased to restrictive policy that they are going to have to cut going forward. And then there's a third point, which is maybe we don't really have a clear understanding of what's going on the FOMC. Maybe there is something to be said for forward guidance sort of losing its clout. I mean, was Governor Myron really that convincing that he single-handedly kept that easing bias in the statement?
There seemed to be some separation, some daylight, if you will, between the minutes and what was articulated in them compared to what the chairman was doing at the news conference. There was daylight there. And there's massive daylight between the so-called consensus the chairman was meant to reflect in the news conference and the subsequent Fed speak we've heard from basically everyone on the committee.
Look, this market is used to being manipulated. It's used to being jawboned. It clearly views this as a whole host of jawboning, and yet the market has actually moved ahead of the Federal Reserve. And this is interesting to me, that in some ways these Fed officials are coming around to the view that the market is putting out there, whether or not they would actually come to a hiking bias. Another story. Okay, the easing bias is going to be removed in June. I think that we probably can say that with some degree of certainty. Going forward, this is the debate in markets. How reluctant or not is this Fed to actually execute a rate hike? How high is the bar in terms of how the data has to come in for them to actually tighten policy? That, I think, is increasingly the debate and is getting priced in the bond market.
Inflation closer to 4 than 3 is deeply uncomfortable for this committee. Coming up this hour, we'll catch up with Katie Kaminsky of Alpha Simplex as the equity rally stalls following fresh strikes. Matt Lazzetti of Deutsche Bank reacting to breaking inflation data, and Matt Stuckey of Northwestern Mutual on why he's underweight US large caps. That conversation later this morning. We begin this hour with stocks edging lower as investors grow cautious over an end to the war. Katie Kaminsky of Alpha Simplex writing, despite the recent rally in equity markets, there is clear fatigue over the continued conflict in the Middle East. Katie joins us now for more. Katie, welcome to the programme. Let's just dissect the bond market sell-off, the individual drivers of it. What's been driving yields higher?
Well, this is a good question because what we have really seen, and I want to point this out, and I really liked what Lisa said, is that you've seen the bond market get ahead. So the bond market has been selling off pretty aggressively since the geopolitical risk sort of got into the markets. We have seen some retracement more recently in terms of yields coming back down. So people thinking that some of this inflation uncertainty is going away, but today just sort of reiterates that it's not gone yet. So we're kind of seeing that come back again today. So you can see that right in the chart that, yields have gone up substantially on inflation concerns, but that hasn't dissipated yet.
Do you think we're overestimating the potential for yields to fall on a resolution in Iran? Is there more to this move up than just the Middle East?
That's a good question. I think the positioning of the Fed relative to other central banks is also important. So if you look at where the US is sitting and how much higher US rates are, that matters. But also the fact that other markets outside the United States is pricing in things like hikes, that does complicate sort of the relative positioning of the US Fed and sort of add on top of that sort of a changing Fed dynamic. So I do think it's not just inflation, it's also figuring out how monetary policy is going to be set in a new FOMC.
This is a great point, Katie. How much does the move that we're seeing in bonds in the United States have more to do with Japan and Europe, frankly, than it does the United States?
I think there's a mix. I mean, just given how much bond moves have priced out cuts and move towards a higher chance of hikes. If you look outside the US, for example, the ECB or Japan, even also Australia, you start to see a much bigger shift globally towards a potential for hikes. And that means that overall, across all regions, that there's more of a chance of hikes, which could put pressure on the Fed. But remember, US rates are higher. So that means that we have less need to move as quickly as other regions.
You follow trends and you follow some of the momentum that we're seeing in different technical readings across the market. And I wonder how much we've seen a breakdown between yields going up and stocks responding in any way, shape, or form. I mean, how divorced is this relative to history when the common mantra was when yields went up, stocks went down, risk assets used to wobble, especially if it was coming with some mixed readings on the consumer appetite?
So I love that you asked this question because we look at short-term correlations between stocks and bonds. And whenever inflation is the key driver of stock bond movements, you tend to see positive co-movement or positive correlation. And we have seen consistent positive correlation between stocks and bonds since March. It is not unprecedented. We've been seeing that since particularly 2022. And it's just a point that stocks and bonds, or bonds basically, do not provide a hedge during periods when inflation is a persistent risk. And geopolitical risk is a key driver of inflation uncertainty. So I think for now, bonds are going to be much trickier for investors to deal with. And until we see this inflation pulse go through and we figure out how much higher oil prices changes the inflation dynamic, you can't count on bonds when things are tough.
At some point, though, will what's going on in the conflict and the inflation driver start to hit equities at all?
It should at some point, because how I see geopolitical risk is that initially it becomes an inflation impulse, which is a stressor to bonds. But at the point where we start to see that we need to have tightening, we start to see an effect on growth, that's when you start to see that the equity markets will react. We have seen the equity markets react to higher yields this month, so that might be an indication that there is starting to be some concern about higher yields actually being a negative driver for equities going forward.
As Lisa and John have been talking about all morning, likely we're going to see the Fed remove the easing bias. Would that be something that could be a catalyst for this equity market, maybe to be softer, or is it already baked in?
I mean, I think I would kind of assume that it's somewhat baked in at this point. I do think it is very interesting that they haven't removed it, just given where we are in the current geopolitical landscape. I mean, just the idea that you could cut rates in a period where you have a huge oil spike, it just kind of already puts the Fed in a neutral stance already. So I think some of it is already baked in, but there's always room for surprise where you could actually see that maybe this conflict accelerates more, or you have sort of more of a chance that that could be even less of a case that, you are going to have a resolution. That could be more negative for bonds.
Kelly, it's good to see you. Kelly Kaminsky there of Alpha Simplex. It's such a different conversation speaking to someone in fixed income or commodities at the moment. Then you speak to the equity guys, upgrading their outlook for stocks left, right and centre. Last week it was CIBC and Chris Harvey. He went to 8K plus. This week it was Ben Snyder over at Goldman Sachs going to 8K. You see Jamie Dimon yesterday of JP Morgan. Check this out for a quote. It's gung-ho, folks. Companies are busy. There's a lot of exuberance out there. That describes this moment for many of the largest companies in corporate America.
He even went on to say that they're over-earning, which created a little bit of a stir in terms of its share price. The bonuses that some of the traders are getting are sky high because the performance has been there. This is actually a frothy market is what you hear from a lot of banking executives when you speak to them, despite where interest rates are. So regardless of potentially underneath the hood of the averages, there is a question here about restrictiveness. Can you arguably say that this Fed funds rate is restrictive if you see frothy market conditions with a prolonged pace of rates at this level? And that is the reason why the bond market has moved ahead of the Fed commentary.
Bill Dudley's words. Imagine if he was still at the New York Fed. Former New York Fed president, quote, "It isn't credible to judge monetary policy as restrictive." Bill Dudley. Imagine if Williams was saying that right now at the New York Fed, the kind of impact that would have.
That would definitely cause some ripples, some yippiness at the front end of the yield curve that already is starting to get a little bit yippy. Longer term, we have to look at all of these dynamics. There is a breakdown, though, in terms of the efficacy of Fed funds policy right now at a time when there is a interest rate agnostic borrowing base, which is all of the hyperscalers that have an existential need to build out and to borrow trillions of dollars. And that is what people are struggling with, reconciling the many different pockets of economies that there are around the country.
That's why there's a bull parade in the equity market. Equity futures right now just about negative by 0.2%, pulling back from all-time highs. With an update on stories worldwide with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. U.S. officials saying Iran violated its ceasefire agreement with the United States. In a post on X, Central Command calling Iran's launch of a ballistic missile toward Kuwait a, quote, egregious violation. American Airlines CEO Robert Isom says travel demand was tremendous in the first quarter. Speaking with Lisa, Isom saying both business and leisure travel has improved despite the headwinds in the global economy.
Year-over-year revenue improved 10-11%, and we're forecasting revenue to improve 15%, year over year in a year where price of fuel has spiked $4 or $5 billion. We're still projecting the same type of profitability that we had last year. That means good things.
Isom going on to say American intends to grow its premium seating at twice the rate of its main cabin seating. Perella Weinberg is cutting almost 10% of its workforce, including a dozen partners. Sources telling us here at Bloomberg the dismissals will be concentrated in industry subsectors that have lagged the broader market. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 13 minutes' time. Up next, we'll get you some morning calls. Plus, Sucharita Gadali at Forrester on an impressive set of results from some of the retailers out there this morning. Best Buy up about 10% in the pre-market earlier on. We'll have more on that in just a moment.
I'm an AI optimist. I think this is a revolutionary technology that for sure has to be well managed. It has to be put in well. That's the way that we see AI. We see it as a superpower that will help us to be able to run the company better, improve our products, and ultimately be able to just do new things as well. It's a capacity creator.
That was the BNY CEO, Robin Vince. Great to catch up with Robin just moments ago. Check out the full interview on Bloomberg.com and, of course, on the Bloomberg terminal. If you're just joining us, welcome to the program. In about 15 minutes' time, inflation in America. Expectations for PCE to jump to 3.8% in the month of April, a full percentage point above where it was in February. And as we mentioned a little bit earlier, the biggest two-month acceleration since 2021. The Fed feeling a little bit offside right now going into that June meeting. Equity futures pulling back by 0.2% on the S&P 500, on the Nasdaq down by 0.3. In the bond market, Treasuries, 2s, 10s, 30s looking like this morning. Two-year yields in America climbing higher for 5 consecutive weeks. Can we avoid week 6? We're up this morning by 3 basis points, 4.06%. Encouraged by this move in crude, higher by 2 to 3% throughout much of this morning. Brent at 96.60, WTI at 91. That's the price section. Let's get you some morning calls. First up, Barclays cutting its price target on Salesforce, keeping an overweight rating, citing relatively small quarterly revenue in the overall context. Your second call from JP Morgan, lifting its price target on Marvell to 240. The analyst highlighting growth across all key product lines. That stock is up by 1.4%. And finally, Wells Fargo boosting its price target on Snowflake to 300, saying its growth and outlook surpassed even the high end of buy-side bulls. That stock this morning, check it out, up close to 40%, up 38% in the pre-market. Unreal. Impressive results elsewhere too from the retailers, believe it or not, in a strong sign for the US consumer. More earnings on deck later. Costco and Gap after the closing bell. Bloomberg's Emily Cohn joins us now for more. Emily, welcome to the programme. We were looking for some beats. We got some. Just walk us through what Best Buy and others are doing, where they're finding success.
So what we're seeing is that even in the face of economic pressure, consumers are still spending when the price is right. I think it's interesting to look at a store like Dollar Tree. They saw fewer visits, so people are pulling back on how much they go shopping, but then when they go shopping, they're spending more. So they saw their average ticket price was up. Dollar Tree, Best Buy, Kohl's, all did better than expected. So people still are shopping, which is an encouraging sign.
Emily Cohn there with the latest. Emily, thank you. That's an encouraging sign. People are still spending, even though prices are getting much higher.
And the fact that you're seeing stock prices up as much as they are means that people have already been somewhat skeptical, and you have seen these shares really beaten up as a result of that skepticism. The idea that the overall index is doing really well masks a lot of bad breath, a lot of really narrow leadership. And the question that a lot of people have is, are you going to miss out the rally in the other parts of the market as you realize that this strength is further and goes further than just artificial intelligence?
Sucharita Gedali of Forrester has this to say. Consumer spend is high because of gas and fuel prices. The average retailer is challenged getting shoppers to spend. Sucharita joins us now for more. Sucharita, welcome to the programme. I asked this question early this week. Where's the sweet spot? And what are we learning this morning about where that sweet spot might be?
Well, the statistics that I'm looking at aren't if these companies beat Wall Street. I'm looking if their comp store sales and their overall revenues are up or down. So we can take a look at, for instance, Dollar Tree. Their numbers were actually up from an year-over-year standpoint in the high single digits. That suggests to me that the consumer is really looking for value. On the other hand, Kohl's numbers continue to decline. It exceeded Wall Street expectations, but I would really say, for the purpose of understanding retail, who cares? You know, are your numbers up or down compared to last year? Their numbers are down compared to last year, and that means that the department store sector, particularly in mass, continues to be struggling, and consumers are switching away from some of those discretionary items into essentials that companies like Dollar Tree sell. So I think that's really what's happening in the face of high inflation numbers.
That said, Sucharita, it seems like people's expectations are even lower than the reality. I mean, just based on the earnings response, the share price response to the earnings. What do you make of that? I mean, has all of that weakness that we're seeing in certain segments of the shopping mall area already been beaten up sufficiently that potentially has created value?
Exactly. And I think that that's really the Kohl's story, is that expectations have been so low, sales have been so challenged for so long, that if you are performing at par or you're barely, kind of showing like negative numbers that are not terrible, if it's like you're off by 1% or 1.5%, that's a win. So I think that that's really what we're seeing. It's not really a sign of strength for that particular retailer, but it's all about beating low expectations, a very, very low bar. The overall macro story is that consumers are spending. They are just not spending in these discretionary categories. We still have a K-shaped economy. People are spending on the essentials. And right now, one of those essentials is fuel and gas. And those prices are out of control, candidly.
Sucharita, all this makes sense intellectually, theoretically. And then we get the earnings, which show strength, which show reaffirming full year forecast, which show that they're basically the same as where they were before we saw oil prices skyrocket. Where's the cognitive dissonance here between what people are telling us, what we see with our own eyes with costs, and the results that we're getting, where margins are expanding, and even places that cater to the lower end of the K, like Dollar Tree, are beating expectations?
Well, in the case of companies like Dollar Tree, the beating expectations is both a combination of the consumer in the bottom of the K switching their dollar share to that merchant, in addition to the fact that they're riding the wave of inflation too and able to charge higher for a lot of these essentials, even though the average ticket or the average transaction volume may be a little bit lower. So I think that's really what we have going on. And again, kind of it is those essential items where we've been seeing higher prices for a number of years. And this is part of the reason that consumer confidence is as low as it is, and why shoppers are so frustrated, is because those essential goods are not, they're not where we're exhibiting value. So I think that's really what is happening. But again, it is more because the consumer is being forced to purchase these essential goods for a higher price. It's certainly not that they are leaning into discretionary items. We're not seeing strength that is outpacing any other category in sectors like apparel, for instance, or footwear.
Do you see any evidence that the higher income consumer is starting to face some cracks?
Not yet. There is, when we look at the higher income consumer, a significant part of their net worth is going to be in investments like real estate or in the stock market. And those asset classes still continue to do incredibly well for higher income consumers. And in terms of their spend level, they're even trading down. That's the only crack that we're seeing. But so they're able to bolster some of the sales at companies that are value merchants like a Walmart or a Costco. The only other place where we may see a crack is in luxury retail. Very, very high-end brands like LVMH or an Hermes. They maybe not doing as strongly as they have in the past, but that's not driven by U.S. retail consumers. That's more because the Asian consumer is more distressed.
And some problems in the Middle East as well. That's not helped. Sucharita, thank you. Sucharita Kothari there of Forrester. Check out Best Buy, up by 7%. This is what people want. My experience at Best Buy. Bought a TV, really tight logistics, very fast delivery, perfect, seamless. That's exactly what you want. That was my experience with that company more recently.
Well, try buying a Nintendo Switch, too, because evidently that's what people are doing. They're going there and they're saying, we need to play video games. And so, John, when you start playing video games, you'll fully understand the draw to Best Buy, the excitement in seeing it in real action.
That's not going to happen.
You're not a gamer.
I'm not a gamer.
Maybe not. FIFA, though. I could see you getting into...
I used to do that when I was a kid.
Yeah, that's cool.
But not a kid anymore. Futures this morning, down by 0.2. Harsh, too harsh, too harsh. Down by 0.2% on the S&P. I'm not judging. I'm not. Might be. No, I'm not.
About to say, right.
Inflation data 5 minutes away. Let's move on. PCE in focus. The Fed's preferred read. The Fed's gauge right now could be closer to 4% in about 5 minutes' time. Closer to 4 than 3 and getting further and further away from 2. And they've missed 2 for much of the last 5 years. And now they seem to be waking up to the idea that that might be a problem. Matt Lazzetti at Deutsche Bank joins us next to react. From New York City this morning, good morning to you all. Equity futures on the S&P 500, negative by 0.2%. Yields just a little bit higher at the front end of the curve, up by 3 basis points. And crude fuel in the move. Brent and WTI higher by more than 2%. Five days, no losses on the S&P 500. Equities pulling back just a bit this morning, though. We'll see if this move sticks. We'll see if it holds. We're down by 0.2% going into PCE data in just a moment. On the Nasdaq, we're down by 0.3. In the bond market, yields are higher across the curve, particularly at the front end, higher by 3 basis points to 4.06%, with crude elevating and fueling this move. We're up by 2 to 3% throughout much of this morning. With your inflation data and more, let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Where to begin? Let's do jobless claims because it's not going to really move the markets today. 215,000 up from 210,000, but still showing a stable labor market. Now, as far as inflation, which is the Fed's main concern these days, we're looking at PCE inflation up 0.4%, a tick lower than what had been expected on a year-over-year basis. That still puts us at 3.8%, up from 3.5%. And remember, the headline PCE is the Fed's 2% target. core PCE up 0.2%, a little bit less also than expected, and that puts us at 3.3%, the expected figure, up from 3.2% in March. So more inflation on a year-over-year basis. Personal income was flat on the month. Personal spending up by 0.5%, which was as expected. That's a little bit down from the 0.9 that we saw back in March. So some movement on the consumer side, a little bit less spending, but still fairly strong with inflation up. Now the biggest question is how much of that spending was because of inflation. The increased spending was because of inflation. We also have durable goods orders out, up 7.9% on a headline basis after an 0.8% gain in the month of March. Now you take out transportation and it falls to 1.1%. So there's a big Boeing effect there. And then capital goods orders, non-defense, ex-air, this is what really matters, down 1.1% after rising 3.9% in March. The expectation was for a 0.4 gain. So some mixed news on consumers and business spending and some, as expected, news on inflation. It's rising still.
Mike McKee, thank you. Just on the margin, not as bad as expected. So equity futures with the smallest of bounces off the low. Equity futures down by close to 0.2%. Yields at the front end of the curve were advancing by close to 3 basis points, now up by around 2 to 4.05%. Much of the move this morning, the epicenter for it out of the commodity market. Brent and WTI still higher by more than 2%. Inflation is elevated, bottom line. And ultimately, for this Federal Reserve, this number's still uncomfortable. Even if you get a small downside surprise on a month-over-month read, this number, year-over-year, still uncomfortable.
Especially because people continue to spend. What I find notable, and you're right, that on the margins, this is a downside surprise, the right kind of downside surprise, but still we're at 3.3% year-over-year. When you take a look at the personal income and the personal spending and the real personal spending, you can see the income is actually slowing down, or actually not growing at all, but spending is increasing, either at pace or above expectations. This suggests that people are dwindling their savings in a significant way. I just wonder how sustainable this type of trend is if the averages reflect anything real on the underlying.
I think it's the right question, Lisa. Mike, I hope you're standing by still, because I think that's the ultimate question for economists right now. Can the spending keep up with higher prices if you're not seeing it in incomes in this country?
Well, that's the problem, because people tend to spend out of their incomes, out of their paychecks, especially at the lower income levels. The folks who get more money from assets aren't affected. But the personal savings rate dropped significantly to 2.6%. So it does show people were going into their savings to keep up the level of spending. And so that, along with the drop in the overall spending rate, portends maybe a consumer slowdown ahead. People paying more for gasoline, people paying more for food. They may have less for other categories.
Mike McKee, appreciate it, sir. Mike McKee down in Washington, D.C. Matt Lazzetti of Deutsche Bank with us around a table here in New York. Matt, good morning. Good to see you.
Good morning.
What's the first take, the early take for you?
Yeah, you notice the inflation data. I think that we contextualize it within the past several years, and we think about 3.3% as being the highest since 2023. Now, obviously, that's not a good outcome. But I think if you strip out the COVID-driven inflation, this is actually the highest core PCE inflation rate since 1992. We are moving in the wrong direction, away from 2%. And our view is that this is not simply about temporary supply-driven factors, tariffs and energy prices, that there is an underlying demand force that is more important. Trend inflation is stuck closer to 3%, and that therefore it is entirely appropriate for Fed officials to be thinking about raising rates.
Thinking or actually raising rates?
So far thinking. Our view is that the Fed is on hold, that they are roughly at neutral. I think you need to have a shift in the narrative from the Fed that needs to take place. They need to downweight the idea that this is about temporary forces. They need to downweight the idea that the labor market is not a source of inflationary pressures, because I agree with that. I think as you look more broadly, the economy is a source of inflationary pressures. The CapEx data that we just got was a little bit softer, but you were looking at very strong AI-driven CapEx growth. When you look at the output gap, according to the CBO, it's plus 1.1 percentage point. You would expect that inflation is well above the Fed's target, given that output gap and given that demand backdrop.
Can the economy remain inflationary if people's incomes are not keeping pace and if they're spending out of savings pools that are dwindling?
Yeah, so I think that's an open question, and the income data this morning was definitely disappointing. I think that you have a consumer backdrop that can weather higher energy prices for a period of time. We have the benefits of the one big beautiful bill from tax cuts. You have a labor market that is producing meaningful income growth. You have 4% nominal income growth year over year. Wealth to income ratios are near record high levels. So I think the aggregate picture can continue to support a consumer that is spending. Obviously, that's not true across the income distribution. You have households at the lower end that are more negatively impacted by gas prices, more negatively impacted by higher interest rates. And so you're still going to have this great dispersion, I think, across consumers.
If the Fed did hike rates, would that slow any of the inflation in the economy that seems to be independent of Fed funds?
Yeah, so I think that's a question that I get asked a lot. In particular, is AI-driven capex going to slow simply because the Fed raises rates by 25 or 50 basis points? And the answer is probably no. The other point is that if it is demand-driven, you have to soften or weaken the economy in order to bring inflation back down to 2%. I think there was a period of time where we were all optimistic that the Fed and the economy was going to be saved by supply forces, that the big labor supply boom that we had and productivity growth was going to save the economy and bring inflation down. We are now entering a 6th year of high inflation. My view is that there's not very much evidence that you can get inflation back down to target without demand weakening. The question is, when does the Fed conclude that they are accommodative and they're not restrictive enough in order to get inflation down to 2%?
Do you think it would be appropriate for them to just shift to a 3% goal or a 2% average, say, over 100 years? This idea of, eventually...
They've done that, haven't they?
I mean, essentially,
Isn't that the
right?
last 5?
I mean, it's sort of like, transitory. We're all transitory in this stage of the universe. But I'm just wondering, from your perspective, is 3% a more appropriate level at an industrial build-out like the one that we're seeing?
I think it's a reasonable conversation to be having if the Fed was at 2% today. Having missed their target for so long and being worried about inflation expectations and an inflation psychology that is embedding higher inflation, a central bank has to be worried that moving the goalposts when you haven't hit your target, it actually makes it worse.
Matt, get
so
to the
they
headline.
move it to 3, why not 4?
How offside are
I
they?
think people care about that difference.
Let's get to the headline. How offside are they? How much do they need to hike in your mind for next year?
So again, our baseline is that they're on hold here. But we wrote a piece recently with my colleague Matt Raskin. You look across a variety of policy rules, which just guides you about where the Fed probably should be given the current economic backdrop, and they are 50 to 160 basis points above current levels for the Fed funds rate.
So if they start moving, it's not once, it's not 25.
I think that's the other part. I think if the Fed concludes that they are too accommodative, that inflation is embedded in a problem, it'd be very strange for them to conclude that they are precisely off by 25 basis points. I think that they would have to view that a sequence of rate hikes is likely necessary.
So you actually think they do need rate hikes, but you have them on hold. Why? Because of politics won't allow it?
Well, no, I think we are optimistic still, somewhat on the inflation front. I think
you don't sound that optimistic.
I don't sound that optimistic. But I think that there's scope potentially that inflation could come down next year. Shelter inflation is coming off. There are still tariff-driven inflation effects. But in part, what I have to do as well is read the Fed's reaction function. It's not at all about politics. I mean, I think if you were to hear Chair Powell and Governor Waller, which I think were out of politics, there's just an embedded narrative that inflation is not a problem, and they're giving time for inflation to come down. And so I think that's in part, my call is both the economic forecast, but then reading the Fed's reaction function. The Fed's reaction function is not there for hikes yet.
You mentioned the consumer being able to get by with things like the One Big Beautiful Bill. The tax refunds now have been spent many times over, according to people that come on this program. They were used Christmas holidays. They were used electricity at the start of the year. Now they're being used for higher gasoline costs. At some point, are they done? Has the consumer now really just dried up in terms of the extra fiscal power they had?
Yeah, so I think there's the refund part, and then there's the additional tax cuts that everybody is benefiting from this year. And that part, I think, has not been completely dried up. But the longer that this war drags on, the longer that energy prices remain elevated for longer, the more worried you become about that outcome. At the same time, the more we muddle through where energy prices are high enough that they are inflationary, but not high enough to actually significantly damage the consumer and growth outlook, I think that's the most hawkish outcome for the Fed. That's essentially what Governor Waller has talked about, where we're kind of around $100 per barrel on oil. There's second-order effects spilling over into the inflation data. You get worried about inflation expectations moving higher. So for me, that's actually the most hawkish outcome, that we just remain in this muddle-through scenario with energy prices near where they are.
Why do financial conditions never matter when markets are going up? I mean, I ask this because ultimately the one method of transmission that the Fed could execute would be curtailing the party in some of the frothiest of stocks, which is the one bear case that people say, but it's not going to happen because the Fed isn't going to hike rates. At what point are financial conditions driving some of the inflation that we're seeing? Because people feel really wealthy when they take a look at their index funds. If they bought the NASDAQ, if they bought Micron 2 weeks ago, they feel amazing and they're going to go out and buy luxury goods. At what point is that going to become a problem for the Fed?
Look, I think it is already somewhat a problem. If you look at the Fed's own models for FCIs, financial conditions indexes, they suggest that financial conditions are adding a percentage point to growth over the next year, that they're additive of a percentage point. That is nearly as much as they were back in 2022 before the Fed started to raise rates. So if you think about an economy where financial conditions are extraordinarily accommodative, where fiscal policy is accommodative, where you have an AI-driven structural boom happening in CapEx, I think that would make you not all that surprised that inflation is actually well above the Fed's target and looks stickier than anticipated. Yes, oil prices is a drag, but it is offsetting these number of tailwinds that I think are continuing to support growth.
Elisa, you basically communicated the cash carry argument, which I think is probably the right one, that if we dropped the easing bias early enough, that you would have seen a tightening of financial conditions that would have done some of the work for them. Of course, markets have gone in completely the other direction because the idea that they still have an easing bias in the face of what we see right now in the economy, where growth at the average level is pretty decent, and what you see in energy and broader inflation, it's pretty amazing to see.
And the bond market is getting on board with the idea of inflation being a bit stickier. Stock markets are not buying the story that bonds are telling them. They're saying, we don't think that a Warsh Fed is going to hike rates. They might jawbone all they want, but we are not listening. But when you talk to strategists, if they were to hike rates, that would be another story.
Really enjoyed the note this week, by the way. The point you make is the right point. This muddle through that we've been talking about, the idea that things aren't terrible right now with energy, that we're not at 200, we're at 1. So you're at this muddle through where you don't see the demand destruction, but you do see the elevated prices. That's a nightmare for the Fed. The Fed knows what to do with extremes. They don't know what to do with this, and that's why they're in a bit of a bind.
Yeah, a supply-side shock that was actually a shock would actually be much more obvious. This is a supply-side unfortunate reality for the United States. Is absolutely a shock in other places, and that's why you see the Fed not seeing the destruction in terms of demand that they would otherwise see.
Matt, what did you say? If you strip out the pandemic, this is the worst inflation number since when?
1992 for core PC inflation.
Oof, wow,
I think that broader context is really important here. Yes, we think about everything within the context of COVID, but COVID was the biggest inflation shock in 40 years. Today's core PC inflation would be the highest since 1992, if not for the COVID-driven inflation shock.
And we've got an easing bias. Amazing. Matt, thank you,
I think
sir.
that'll come out in June.
Thank you. Matt Lazzetti at Deutsche Bank. You're not the only one who expects that change on June 17th. With an update on stories elsewhere this morning with your Bloomberg Brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, recapping the data we just got then. The PCE, the Fed's preferred inflation gauge, meeting estimates. The index up 3.8% in April, marking the biggest two-month acceleration since 2021. Jobless claims coming in higher than expected at 215,000 for the week ending May 23rd. Apple's overhaul of Siri will be a centerpiece of its next iPhone, iPad and Mac software. Sources telling us here at Bloomberg the update will feature a new interface and chatbot-style app. Siri will have the ability to understand personal data and analyze on-screen content. In sports, the Carolina Hurricanes are one win away from the Stanley Cup final after shutting out Montreal on home ice. The Canes scored 3 goals in the first period, and Frederik Andersen stopped all 18 shots he faced. The series winner will face the Vegas Golden Knights for the Cup. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Matt Stuckey of Northwestern Mutual on why he's underweight US large caps with an equity market at all-time highs. That conversation up next.
The inflation data, I think that we contextualize it within the past several years, and we think about 3.3% as being the highest since 2023. Now, obviously, that's not a good outcome. But I think if you strip out the COVID-driven inflation, this is actually the highest core PC inflation rate since 1992. We are moving in the wrong direction.
Framing matters, and that is deeply uncomfortable framing for this Federal Reserve under Chairman Powell, before we even get to Chairman Warsh. That was Matt Lazzetti of Deutsche Bank. Equity futures this morning recovering off the back of recent economic data. Equity futures down by not even 0.1%. 5 days, no losses. Could become day 6. The Nasdaq down by just 0.06%. In the bond market, yields were higher at the front end of the curve by close to 3 basis points. Now up just by 1. You'll notice the rally building at the long end. Not a big rally, I know, but yields are turning a little bit lower. 10s, 30s. Not a great read for growth this mix and the data we got 20 minutes ago.
Yeah, you saw income not keeping pace with the spending that people are executing. You're seeing savings rates coming in. You're seeing spending continue to outpace what people can see from their wage increases. So this leads to this feeling that it's not sustainable, that it can only go so far. And so even though you are seeing resilience among some retailers, people are confident that it's not going to last forever.
Let's talk about some of those single names. Some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with a big mover to the upside, and that is Snowflake. Shares are still up nearly 37% in the pre-market after it raised its full-year outlook and said it signed a massive deal with Amazon Web Services for $6 billion. This is helping to ease fears around the software sectors as investors had grown increasingly worried about that disrupting the software industry. Turning to the retailers, where we are also seeing a big upside move there. Wow, Kohl's now up 17.5% after the retailer posted a beat. But to be clear, comparable sales were still down and it still lost money last quarter. But both came in better than fear, showing you just how low the bar is after a brutal sell-off in this name and in the broader consumer discretionary space. And we end on Dollar Tree. Those shares also rising, now up 18% in the pre-market. Wow, I can't believe these moves. After the discount retailer posted a beat and a raise, and the consumer story here is interesting. Fewer people are actually going into the stores, but when they do, they are spending more. John?
Yahara, thank you. You can learn a lot about expectations with a move like that off the back of earnings like those. You learn more about positioning than you did maybe the numbers themselves.
Kohl's sales are still going down. So when you start taking a look at a 17% gain, you start thinking that bar is on the ground.
Let's talk about the mega cap stocks, the large caps in America, an equity market at all-time highs on the S&P 500 coming into today. Matt Stuckey of Northwestern Mutual writing this: we're positive on the immediate term on stronger broadening earnings trends, reinforcing the case for diversification. We aren't abandoning exposure to US large caps, but we are underweight. Matt joins us now for more. Matt, explain yourself. I'll ask politely. Just explain to me, with stocks all-time highs, why you don't like large caps right now.
Oh, good morning, Jonathan. I think I would add a comment slightly underweight is probably to better kind of clarify our position. And in aggregate, if we look across different types of equity exposures in our portfolio, we're more neutral in terms of our exposures. We just prefer allocations to things like small caps and mid caps here, where that broadening out is taking place despite higher interest rates this year. You're looking at small caps and mid caps that are still on the leaderboards, above U.S. large caps. And it kind of goes to show that you don't have to just concentrate in U.S. mega cap stocks to earn, attractive returns in the equity markets.
To your point, we have seen that small cap outperformance more recently, Matt. I think last week was another week of just that. If it's not rates fueling it, Matt, what is it?
It's earnings growth, Jonathan. I mean, I think if you look to mid-May till present, we have seen an earnings revision growth story in small cap stocks and mid cap stocks. That's really been absent from 2023 through the second quarter of 2025. But as we've started to kind of see some healing in the labor market, as we started to see growth start to spread out across the economy a little bit, as the Fed moved rates down about 175 basis points, that growth has started to spread to things like small caps that are more cyclical. Now, higher interest rates so far this year are a headwind to that. But despite that move from 4% to 4.5% on the 10-year, despite anticipated cuts from the Federal Reserve, now we're in polite company talking about the potential for hikes. Small cap stocks have still led this market this year, and I think that's just a testament to some of the rotation under the surface of the market.
If the Fed were to actually start signaling that they were ready to hike rates, because we are seeing the highest pace of core PCE year over year, stripping out the pandemic going back to 1992, would you continue with this thesis?
I think that's an interesting question. It certainly would be a bigger headwind, and we would revisit whether or not some of the kind of more secular reasons why we like the small and the mid cap space might be overwhelmed in the shorter term by that headwind specifically. But I think one of the unappreciated areas that we like about the story is that the labor intensity levels of small cap stocks and mid cap stocks are just materially higher than large cap stocks. And so if over the secular horizon, artificial intelligence is this massive productivity driver, you have to think that the torque in terms of the P&L and the operational leverage potential in these businesses is a little bit more outsized. And so to us, we like that from a secular perspective, but certainly in the intermediate term, these are more cyclical parts of the market that are more sensitive to changes in monetary policy and financial conditions that are out there in the economy.
Matt, how do you frame out higher oil prices given the fact that you're in much more consumer-exposed areas? I mean, do you see that as a potential problem, or is it a sign of resilience that hasn't been a main topic for a lot of these conversations?
I think it's the latter. It's more of a sign of resilience. It is a risk, though, that if this were to escalate further from here, if instead of $90 to $100 oil, we're talking about 125 plus, and that persisting throughout the summer, that could be more of a detriment to the consumer. And case in point is kind of look at the last 6 months of a proxy of national income, which just jobs added, how many hours people are working, what they're being paid for that work. That's running around just over 4% or so. But if you look at the last 6 months of CPI, that's pushing over 5% on an annualized basis. And so there's some real income compression happening at the consumer level for those that don't have financial assets. So if that were to persist, that would be an incremental downward pressure on the consumer. And so that's definitely a watch point. I think if anything, tighter financial conditions through higher rates, through higher energy prices, to me, it just speaks to maybe a little bit of a narrowness coming into the markets. And we're seeing that under the surface ever since this conflict kicked off at the end of February.
Hey, Matt, it's good to see you. As always, Matt Stuckey there of Northwestern Mutual, and why he's underweight the large caps, why the preference is firmly elsewhere at the moment, including small caps, which did pretty nicely last week.
Yeah, underweight, not really underweight, slightly underweight, maybe more sort of neutral. When you take a look at the overall portfolio, it's sort of leaning into some of the more cyclical areas, which is what we're seeing this morning. And it's not because there's such resounding growth there. It's that earnings have beaten there, too, amid very low expectations already baked into the price.
Operation Economic Fury. Have you seen this message from the Treasury Secretary, Scott Bessent, just moments ago?
I didn't receive that
Operation Economic Fury, is this about how they continue to go against the Iranian regime by their new OFAC sanctions
Troops
against
aren't getting paid.
the tolling booth?
Police aren't reporting for work. Khark Island shut down. Iranian economy and currency are in free fall. Goes on and on and on.
Well, look, the Iranian economy is not doing well. But the issue is, of course, this is existential for this regime. So they potentially can outlast the domestic pressures that are going to be on this White House.
This market's not paying attention to that this morning, just about unchanged on the S&P 500 going into the opening bell. The cash open just around the corner. Coming up tomorrow, we'll catch up with Max Kettner of HSBC, why Max is still Max, bullish this market. Lindsay Rosa of Goldman Sachs, Alex Altman of Barclays, and don't miss this, the Chevron CEO, Mike Wirth, joining the programme tomorrow morning. Looking forward to that. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.